If you could please take, yep. Okay, let's do this one at a time. Joe, could you help us? If you could come and take your seats, please. Thank you. That's it. In your own time. Hurry up. Who gets the front row seats here? Is this yours? All right, you're safe. You're safe behind the table. Okay. Morning, everyone. Morning. Morning. Good morning. Right. Okay. How's everyone? Fantastic. Who's going to the dinner? About half of you. 40% of you. Fantastic. Good stuff. It's going to be a good night. I've got some great after-dinner entertainment lined up for you. I'm not going to tell you what it... and Christina, why do you find that amusing? What were you thinking when I said that? Okay. You may have been the only one on that wavelength. I'm not going to tell you what it is, but it's really good. Okay. So let me tell you what we've got lined up today, what the format is for today. So between now and coffee, I'll be asking people to volunteer to come up to the front. We have a stool. Yes, we have a stool. To tell us what's been happening. We've got a couple of tense. We're on the cusp of deals completing situations where I think you'll find the story, the learning, very interesting. And we'll do that up until the coffee break. After the coffee break, we are going to split into pairs and do some valuation and deal structuring exercises. So by lunchtime, as long as everyone moves at quite a pace, we will have just about every single one of you have structured and valued a deal. Okay, so we need to move pretty sharpish on that exercise. So I'll give you the instructions and let you get off and do that, and then come back so we can do a recap up till lunchtime. So that's our exercise this morning. And then this afternoon, I've organized this afternoon as a direct reflection of a few things that people said that they needed some additional help with. And I thought, well, if a few people do, then maybe a lot of people do. So this afternoon, I have got an accountant coming in to speak to you who's bought 5 businesses herself. So she's done this. And she will be taking you through the acquisition process from an accountancy perspective. Now, what I always say to you, and I still say to you, is that don't try and be an accountant, don't try and be a lawyer, don't try and be a conveyancing solicitor. You get other people to do those things, because how long is a law degree? It's 4 years, isn't it, to be able to practice. An accountant is, how long is an accountancy to get all your qualifications in accountancy?
5 years.
5 years, right? So you don't want to go off and study 4 years of law, 5 years of accountancy. You might as well just go and hire someone who's done all that already. Leverage their time and their expertise. But it is useful to be able to understand what they're saying to you. So you will be taken through some exercises this afternoon where by the end of the day, you will have an understanding of reading a balance sheet, reading a P&L, and understanding the green flags and the red flags. And we've actually got some, I'm looking at one of these here. So yeah, so you'll be understanding all the different asset classes, all the different liability classes, and understanding shareholders' funds and all of those things. And I know for some of you, if you've been in business a long time, this would be second nature to you, but it's always good to have a refresher. And those of you who would like to take it from the ground up and learn the absolute basics and fundamentals and essentials, you get all that as well. And that is the entire afternoon. So your head will be spinning by the end of the day, and then we can go downstairs to the bar and have a drink, okay? Because you will need it, I think. So how does that sound? Fantastic. Book recommendation coming up. especially this time of year, as we are in that homeward stretch leading up to the end of the year, and I'm already thinking about next year, and I guess many of you are too. Get this one on your Christmas list. Brian Tracy's Goals book. And there are, of course, many books written about goals and goal setting and getting those goals set correctly. But Brian Tracy really is the expert on it and has been for decades. So Brian Tracy's Goals book. And this is actually also on Audible, if you prefer listening to books. And Brian Tracy is fantastic. I've put him on in the UK twice over the years, and he's been incredibly popular. Anyone read it already? Anyone had this? No? Who was the yes? Sorry, I'm hearing the yes, but I can't see the mouth moving. Oh no! Oh, it's no. Oh right, okay.
There's a PDF that summarises that from Brian Tracy.
A PDF that summarises it. Okay, great. Yeah, you're looking for the shortcuts already. Yeah. Okay. Well, yeah. Read the summary. I guess you find that online. And then, if you like the summary, go for the whole book. There you go. Fantastic. Alrighty. So, let's get the stool. The stool ready. Who's our first volunteer? Felicia. That hand was straight up. Let's give her a round of applause, shall we? It's a long walk from the back to the front. And a walk. You can stand, you can lean against the stool. Yeah, there you go. So, oh, you need a microphone. There you go. Right, which means that the people at home can hear. Remember, the mic is really important for the people at home. So, and actually, could you just step a little bit this way? Otherwise, the people at home can't see you, I don't think.
How's that?
Yep, a little bit more. Just in front of the, there you go. Perfect. Yes, smile to the camera. You're now you're being beamed internationally now. So, what's been happening?
Managed to sign my first heads of terms.
Yes, very good. Well done.
He's waving his hand, I don't know what that means.
Or the mic isn't on.
Oh.
Ah, well that would be helpful if I did that.
Yes.
Maybe you could come and help me.
Is there a button?
I don't know. That's it. There you go. Thank you. Oh, that easy. There you go. Right. Edit. Start again. So, oh, that's it. Just take your time. Make yourself comfortable.
Yeah, managed to sign my first heads of terms.
Yay!
I think it's that commitment, the verbal commitment to everybody last time, because I said I wanted to speed things up.
Interesting that. So,
Yep.
Interesting. So you feel that telling everyone that you are going to get this done
100%.
puts a little bit of pressure on, doesn't it?
More,
Yeah.
more. Not that I wasn't focused before, but I think Gavin and Phil have done that before as well. That not that I have told so many people about my goals before, but basically it's 1.6 million turnover, 350 net profit, and we're paying 400K in the initial consideration from his bank account, and the rest is deferred over 4 years.
Oh, very good.
Yep.
Nice one. So yeah, great, fantastic. So what's the total consideration?
$1 million.
1 million.
Yep.
Okay, nice
So-
round number. And how did you reach that number? What was the process?
I saw him in July. Obviously came through a letter. My sector originally, my experience is in technical solution sales over 20-something years. And I decided that it was quite a difficult sector to fund. I've tried that before. I have sent quite a few letters there. And anyway, I needed a sector which we can fund and with people who are ready to retire. So in technology and digital marketing, nobody is ready to retire. So I decided that specialist manufacturing is going to be my sector. And I researched just that, in terms of 2 to 10 million turnover, roughly at least 6 employees, and also about 2 hours away from London. So that was my niche, and that came through a letter. This business is in London, perfect, not too far away at all. And I went to see him, great chemistry, amazing energy. I love the I love what they do, which is creating installations, and their clients are buildings, production houses, galleries, museums, and they have clients in Singapore, New York, UAE, and the UK.
Okay, fantastic. So give us the situation of the owner then.
He's late 60s, very much wanting to retire. He's been in this sector 30-something years. He's been building this business for 37 years.
Okay, wonderful. So it was about retirement.
Yeah.
And so you're paying £1 million. The 400 on day one, and that's from cash at bank.
Yeah.
So you're paying £1 million for the balance sheet.
Yeah.
So you're getting the cash. Are you also getting any debt? Is there debt in there?
No, he's going to clear that out. So we've
right,
come through
okay.
quite a journey, just
Yeah.
to say, we started off the first time I met him in the business. It was, what do you need? And he said $1 million. How did you come to that? It was the EBITDA calculation, and then.
But it was also this feeling that I'm a millionaire.
Yeah.
Is that sort of
Sure.
that feeling? Yeah.
So second meeting, we already went to. I offered a 650, and drafted the heads of terms together, and then he goes away and comes back and says, "Oh, I need 1.75." Right.
Right. Yes,
So
I remember,
went
yeah.
away for summer, and I said, it's not going to work.
And
We're in contact.
why do you think it suddenly jumped from 1 to 1 3/4?
Basically, at his stage of life, this is what he said. He needs the money to live and pay off all his debt. That's his answer.
Yeah, sure.
So it suddenly went from a logical calculation to not.
To an emotional. Yeah. Okay.
So we still met up. We still continued the conversation, and then after the summer we came back and we met up. We tried to get to an agreement a couple of times, I would say face to face, but we didn't really. And then of course from the last time we met, as in the last mastermind, I went back and I thought this is it. This has to be. We have to calculate this, and I came back with. Advice from other people, and I said, the only thing I can do is 700.
700.
700.
All right. So it started as $1 million.
Yeah.
Went up to 1.75, and then you went back down to 700.
Well, I offered 650 to start.
Oh, 650.
Yeah, 650
Right,
to
okay.
start. Yeah.
Okay.
So he knows that I.
So it's bounced around a bit, hasn't it?
It has.
Yeah.
It has. But I have had advisors, and I have an FD now, since you
Well done.
suggested that we do.
Absolutely.
And so he knew that I was serious, that I'm looking at other businesses. I'm meeting. I can tell him plenty of statistics of other people, and I said I am sending out to other heads of terms. Yours could be the third if you want, but in a couple of weeks that'll be it. And so.
And is that tonality the way you communicated to him?
Yeah.
Because it sounds like you mean business, right? Yeah. You're not messing around here.
Yeah.
Yeah.
And then it was literally like a beginning of the week. It was straight after this mastermind, and I said, that's the number, etc. How about we meet? We discussed Friday morning was the only time I could make it, right? And then I came back with, look, your 1.75 is nowhere near, and you'll have to think about it. You'll have to think about the fact that I'm not going to meet up again. This is learning from other people. We're not going to meet again, and we don't get to a written heads of terms anymore because I have many other meetings to get to. So if that works for you,
you just created a deadline for the decision making.
Yeah.
Yeah.
So we're not going to meet up unless this is right for you, and then we'll draft the words together. And I didn't hear from him until the Friday morning. And then he said, are we meeting today? Are we meeting? And I said, we're not meeting unless it's a number closer to mine. And he knew that was true. And then he said, yes, it is a lot closer. So we met, and literally, this is also something I learned, thank you, Phil, is that I sat with him. We agreed the number, we got to the number, and he said, okay, send me the heads of terms. I said, no, you're not going anywhere. We're doing this now. I'm not coming back here. And literally, he sat with me, and I wrote the heads of terms together on my laptop.
Which is,
Yeah.
if you go right back to fast track, that's kind of what I did say. Yeah. But that's the best way of doing it, because as soon as you start pinging emails backwards and forwards, all it takes is they talk to someone else says, oh, you can get more than that, and immediately it all starts to crumble. You got them. Let's get them while they're hot.
And that's it. So due diligence is starting
done.
next week.
Fantastic,
Yeah.
fantastic. So, do you have a target completion date?
Well, I am working around some holidays as well.
Okay.
So target completion date is 22nd of Jan.
Okay, and that's on the heads. That's in the heads.
In the heads, yes.
Yes.
But the due diligence will...
Did you use my template?
I did.
Yeah,
I
okay.
did.
It's on the schedule.
Much
at the
easier.
front.
Yeah.
22nd of Jan.
Yeah.
Okay, but there's some
But
hesitation around that.
the due diligence could finish much earlier.
Yes.
It
To be
could,
fair, that's
but we never
probably
know.
not the thing that will hold things up.
Right.
So the part that holds things up typically, as some of these guys know, is the property aspect.
No property.
Yes, but they operate from somewhere.
Uh-huh.
So what was it, like a warehouse?
Yeah.
Yeah. So do they lease the warehouse? Okay. Are you buying the company?
The company.
You're doing a share purchase.
Yes.
Okay. So you're going to get the lease.
Right.
Your solicitor will look at the lease.
Right.
And will tell you how many years are left.
Right.
Because do you know that number yet?
I can't remember.
Okay.
Yeah,
because if there's only a few years left, your challenge is that the lease might not be a renewable lease.
Right.
And then in 3 years' time, you're kicked out of the premises.
Right.
Now, to be fair, that might not be a problem with a business like yours because it's not location specific. It could be in any warehouse, couldn't it?
Right.
Where if it's a dental practice, and you're kicked out of your corner site on the high street, and 50% of your trade is just walk-ins, it's game over, isn't it? So that is obviously something that you would be
Right.
look at, and a renegotiation of a lease, as some of you are experiencing currently, can take a very long time. Well, we were just saying earlier, right? It can take a year. Yeah.
Oh my
absolutely.
God.
Yeah. Yeah.
Okay.
So great. Any concerns that you have? Anything that you're worried about? Any aspect of it you're not too sure about that maybe collectively we can help you with?
Well, only the fact that it's not high volume. It's very low volume and high margin business. So there is cash flow is the most important thing, right? So that's the only thing. But obviously, because he has cash, he has done invoice discounting before. I'm not planning to do that in the initial consideration, but I haven't gone through it before, so
Sure.
we'll see what happens.
It sound like you need to. Are there outstanding debtors? I guess there would be at any point in time. There's going to be.
Yeah.
And are they? You said the clients were. Did you say galleries, and so there'd be B2B debtors? Okay.
500 or so. Okay.
What outstanding at that moment?
Yeah, roughly.
Oh,
yeah,
right.
Yeah.
Okay.
But I'm not planning to. I don't want to sort of go down that path in
No,
terms of.
you might not need to for the acquisition.
Yeah, but
But
later.
it could be an interesting way of releasing some cash.
Right, later.
And I don't know what the current. Anyone made any inquiries about invoice discounting in the last few weeks? Yeah. What sort of numbers are people quoting? Percentages? 1.5% a month. Oh my goodness, really?
That's the cost, isn't it? That's the cost, yeah.
Oh, the cost. But what can you release in terms of loan to value?
Oh, 85%.
Really, 85. Wow. Okay. So that's like over 400,000.
Right.
So you
we'll
can
see what happens,
get an advance of 400,000, and as long as all of those people pay, and they're probably not going to lend you the money unless they are within credit terms and are suitable debtors.
Right.
Then there's a potentially, just putting the idea out there could be a deal fee in there, couldn't there?
Could be.
In fact, I think there should be.
Right. Absolutely. Yeah. I need one. Yeah. I'd like one. Absolutely.
Yeah, and I
see
think
what
you should.
happens, yeah.
Or it gives you some working capital.
Right.
or it actually funds acquisition number 2.
Absolutely.
Okay? And if you're thinking longer term, maybe funding acquisition number 2 might be the way to go, because then you could take that 400,000,
Right.
and then you can go to the next deal, and you can get someone to match it with some cash flow finance,
Right.
and you've got 800,000 as an initial consideration for a far bigger business, and then you do the same with that one,
Right.
and you parlay that into the third.
Great. Sounds good.
Good.
Thank you.
Don't go. Any questions? Yes. Now this is going to be the chat. Could you? I don't. Is it my eyes? Is that on?
I don't think so.
I don't know. Could you help, please? Thanks.
It's not on. I don't think so.
There you go. Note to self: make sure the mics are switched on before the day starts. It is on. Oh, fantastic.
it's very
Okay.
on.
There you go. Right. Let's pass this mic. If you can just pass that behind you. To that third table. Thank you. Your question.
So the question is, who's going to run it day to day when he's gone? Because obviously he'll have loads and loads of contacts in the industry,
Yeah.
etc.
Yeah. I mean, one of the things I really liked about the business is like the least amount of years that someone's been there is 5. So he has a 2IC who's been there for 12 years. So we're going to promote him into, he's already doing exactly what he's doing because they have a huge order which is going to take with Harrods, which is finishing before Christmas, and he's going to be gone on holidays by the beginning of December. So this guy is running all of it. So we're going to make him the GM, MD / and the owner's going to be there for 6 months. At least 6 to 12 months, but I mean not every day. So
No, well, you don't want them really there.
No, yeah,
because
yeah.
that's when it actually starts becoming disruptive.
Right.
But you want the seller to be on
Yeah.
a consultancy period.
Right.
Handover, then a consultancy period.
Yes.
Because as I think you realise, when someone's been in the business for 30 years, there's a lot of information is going to be in their head.
Yeah. So, yes, Steve.
Going back to your negotiation, he wanted 1 million, you offered 650. Is it possible that if he'd have stuck at the 1 million, you'd have finished up somewhere between the 1 and the 650? So therefore, he had to say, no, I want 1.75, knowing that after he'd finished negotiating, he'd be at his 1 million. Was that a tactic on his part to get his million?
I don't know. I mean, I don't think. I mean, we entered. I mean, 700 was still like, he wasn't going to go to 700. Maybe. I mean, who knows? But I don't. I mean, we told me exactly what his mortgage was, and he's in his late 60s. I just didn't feel that.
Steve makes a good point.
Yeah.
But I suppose the follow-up question would be, does 1 million straight make sense? Does it represent what the business is worth?
Well, I feel it does.
Okay.
Based on the other businesses I've met.
And I'm not sure if you told us the earnings. How much does it make before tax?
1.6 million turnover.
Yeah. How much do they make in terms of profit before tax? So earnings as in profit.
Yeah. Before tax.
Yeah.
Oh yeah.
Or even after tax, if you know
Yeah.
that figure.
What after tax?
Either.
Yeah. 350, right? Roughly. Roughly 350. Yeah.
Okay, 350. Right.
Yeah, roughly 350, 380, 400.
So in actual fact, that's like 2.5 times, right? 2.6, 2.65, something
So
like that.
it's I think it's very reasonable.
Yeah. And you get 400,000 of cash.
Yes. And $500,000 of the debtor book.
And $500,000 debtor book, and presumably there's some sort of stock in there, but probably it's not worth
Not
very
much,
Yeah,
not much.
You're right. The debtor book. So when you add it all together, that's actually damn good, isn't it?
I think so. Yeah. I do.
So,
Yeah.
so really, if you wanted to be, and so the 600 that you're deferring is over what period of time?
4 years.
4 years. So that's 125 a year, and it's making 350. So that works
Yeah.
out. You need some working capital.
Right.
So giving him all the cash that's at bank is probably
It may not happen.
A little tight.
And this is another thing, right? So it's surplus cash, and he knows that.
Okay.
But he's also taking out any of the creditors, which is there's a
Yeah,
few
so
loans.
he's
There's
gonna
not
pay-
much left.
So almost it doesn't make sense because he's
Because I said
Pay-
said exactly that I don't want to have a
it's
problem.
debt free, but it's with the cash, where normally it would be cash free, debt free. But you're getting best of both worlds.
Well, he knows that I don't want to have a problem with cash as soon as I started. That's why I said, that's why we've gone through this,
Yeah.
sort of a few
That's great.
times. Yeah.
Sounds really good. So what you want to do now is make it happen as quickly as possible.
Absolutely, yeah.
Before he goes cold on
Right.
the idea.
Yeah, yeah.
Because sellers can blow hot and cold.
Right.
And all it takes is someone to say to him, "Oh, well, you could get you don't want to be doing that. You could be doing this." So so momentum.
Right.
Let's get him caught up in the momentum of it. So you need to get him. Has he instructed solicitors?
Oh, yeah. And accountants.
Okay, he
Yeah,
has.
yeah.
So and have you? Yes, you have.
Yes.
Yes. So you need to get that draft
Yeah.
SBA over to the other side,
Right.
like now.
Got it.
Because the faster, do you see how the momentum?
Right.
It's easy to say, right, I've got the deal, and then I'll go and do something
Got
else
it.
and come back in 2 weeks, and that's when it goes wrong.
Right.
It's like, I've got the deal. Right now we need to keep.
Right.
Now we need to keep pushing.
Okay. Thank you.
How do you feel?
Awesome.
Amazing. I'm proud of you.
Thank you so much.
Thank you. Thank you. Thank you. Thank you. Very good. Nice one. Who's next? Step up to the front, sir. There you go. How you doing?
Is this on? Yes.
Good contributions in the LinkedIn group recently.
Oh, well, thank you. Well, see, that's all I wanted to say. Yes, this is going to sound like a rerun of what we just heard. The numbers are suspiciously the same.
It's the same business.
But I'm yes. Yes, we just got to our first heads of terms.
Well done. Hey.
Well done. Yeah, it's 1.1 million total. 400,000 upfront, part debtor book, part my own money.
Okay. Yep. So the 400 comes from releasing cash from the debtor book.
Yes.
Yes.
There's some cash
Yep.
that we can use.
And cash at bank already.
And cash at bank already.
Yep,
And,
okay.
and some will be obviously I'm putting in, I have to throw in. It's not quite as good a deal as.
Okay.
Yeah.
All right. Well, let's see if we can work around that if we can.
Okay, good. That's
Yeah.
what I'm. And then the rest is over 3 years. We're in due diligence now.
Okay.
And compared to everything I always hear from other people, we haven't had any of the usual fall downs. But we've had a whole new set of things, probably driven by the fact that it's an odd industry. It's an odd.
what is it?
In aerospace.
Aerospace. Oh yeah.
So they're in design and certification of aerospace, but they also have MOD contracts, which means security vetting, nominated post holders, and all the rest of it. So we're trying to sort that through. And as anybody knows, as soon as you get the government involved.
Yeah. Sure.
So,
Okay.
so those are things. That's not something the group can probably help with unless
Yeah,
there's
it sounds very industry specific. Okay. So total consideration 1.1, 400-ish on day one.
Yeah.
Balance over 3 years.
There'll be another big chunk in 6 months. They were insistent. That was the only thing that got the deal across the line. Another
Yeah.
150 in 6 months, and then 50 in 12, and then the rest is over 3 years.
When you say over 3 years, on an annual basis.
On an annual basis,
Brilliant.
yes.
Brilliant. Because the downside of doing monthly deferred is that 4 weeks comes around really fast, and you don't want that monthly deferred coinciding with your payroll, and
Yes.
yeah, you want to be pushing out those payments. I'd prefer larger payments further into the future than smaller payments now.
When we were sitting there and I was on the laptop, your words were ringing in my ears,
Okay.
going, no, not quarterly, and they started to say, my accountant said, and I said, your accountant's not here, and I was thinking, if I don't do this, Jonathan will be.
No, that's fantastic. So, and how much does the business make?
So it'll be, their year end is coming up in a quarter. They'll be on 1.7 million turnover. And then because of these contracts, they'll be on 3 million next year. next
Okay.
fiscal year. And the contracts there's 6 million total in contracts to run out over the next 4 years.
Right.
Yeah, so that's essentially the value in the business.
Yeah.
Because
so
it's
you've
at
got to
this.
make sure those contracts are strong.
Well, that's the whole.
signable,
That's
yeah.
this whole loop of trying to get in to see the contracts, but some of the contract is going to have to be redacted, which I'm okay with because of this because of
Sure.
the Official Secrets Act. But as long as we can see the commercial terms and I know what's there in terms.
You've got to sign the Official Secrets Act.
I have to be security vetted, which means they'll come in and ask me, why were you looking at this on your laptop 6 years ago and all this type of stuff. Yeah. Yeah.
And that's where it could go wrong, right? Okay.
What's that? Yeah, no, I know. I know.
I've done it before. If you have questions, I can let you know.
Okay. Okay. Oh, okay, good. Perfect, yeah.
So how did you find it?
Well, here's the thing. You probably don't remember this, but this would have been last year when I asked a question online, and I said, what about going through brokers to research the market? And you said, don't do that. That's ridiculous. This one actually came from a business that I found online, and there is a good learning thing for me, and I will do this again. They had been with a broker or an M&A specialist. They had spent 3 years, re-upped with them twice to try to get this sold. They had been told the old, you want 10 million for it, we'll give it, we'll get 10 million. They got beat up through that in COVID. So by the time I sent out the letter
They were so
last
frustrated.
year, it was 6 months, it was earlier this year that they finally came back to me. And I hadn't forgotten about it, but I had to look back through my database. And there, sure enough, it was like, oh yeah, I had sent them a letter. And it was an email to my letter 6 months before saying, yes, we're actually interested in selling now. And what they had done is they had waited until the day that the agreement with their broker had.
Do you know who the broker was?
Yes. Take a guess.
Oh, KBS. Or
Yes.
someone.
Yes.
Oh, really?
Yeah.
KBS selling an aerospace business. That doesn't really make sense. Yeah. Okay.
Well, no, they didn't sell it.
Well,
Just
okay,
all
well,
that.
well, there you go. That's why it didn't make sense.
Yeah,
Yeah. Fantastic, fantastic. So, what have you learnt from the process so far that you could share with everyone that would be helpful?
So, other than the ones that we keep hearing all the time, keep sending out the letters, stay on it. I suppose the number one thing is other than staying positive, which is kind of a soft skill, but being absolutely ready to jump on something when it comes. So I was actually away when this email came in, and my initial thing was we were just kitting up to go out for supper, and I thought, actually, no, I should actually just get back to them. And I'm glad because they actually emailed straight back and said, when can we set up a meeting? So that all happened in a flurry of emails from their initial email after 6 months in about an hour or two.
Okay.
So jumping on the
Being
deal.
quick to respond.
Yeah. The other thing, too, and I did get this from somebody, I can't remember who it was, on a couple months ago, about don't worry too much about what the heads of terms, I mean, you know, the basics have to be there, but that's just to get you, I think he used the term exclusivity tunnel
Yeah,
or something.
I'd say that. Yeah.
Yeah. That was a very important one to me.
Yeah, no, that's actually so. So you've got four elements of heads of terms that are legally binding. So it's jurisdiction, confidentiality, who pays fees, usually paying your own fees, and exclusivity. And that exclusivity pushes every other potential buyer out. So if you can get yourself, it's got to be at least 12 weeks exclusivity, but more. Then if they're talking to anyone else, then they have to discontinue those conversations and let you know if they are approached by anyone. Mm-hmm. So it becomes a one-horse race, which means that your negotiating position is an awful lot stronger. So you can use that that exclusivity as your sort of negotiating superpower because you know that they can't do the, well, someone else offered this. That's gone now. Well, they're not here anymore. Yeah. It's just you and them.
I think psychologically, especially with these, the two directors and owners, once we sat down for the second meeting, because their main thing was really more about me. What can you do? And their main thing when I did the old, again, which I've learned here, well, what's important to you? Mm-hmm. Yes, the million. The million was the thing too. It had to be 1.1 million, and the 1.1 million because that's $1 million after tax.
Yeah.
So I said okay, which will come to another big learning point. But the main thing with them was, who is it that's buying this? The one question they said, our accountant had to ask, wants us to ask you, can you afford it? And I just said, well, yeah.
I
and
wouldn't be here if...
well, I just
yeah.
basically said, well, yes. And they went, oh, okay, and I ticked that off. That was, which was, so anybody who's sweating over that question, I don't think it's as important to them necessarily.
Yeah.
But it was what was going to happen. And they, I can't give away, for obvious reasons, a lot of what they do, but put it this way, if they ever go on vacation and fly anywhere, it's very likely that they may have something to, they may see one of their own products there. And they said, we'd like to see that in the future, knowing that someone's looking after our business.
Okay.
And I know you feel a certain way about how, they always say that and then they go away, but because it's a small business and they've been in it for so long,
Sure.
and it's a passion of
No,
theirs.
if that's what's important to them, that's what's important to them.
So to hand over to somebody that they trust was
Yes.
a big one. But the other thing too was in terms of getting the deal across the line, a very important thing for me was keep the long game in mind. This is a platform company. This is a perfect company to buy other companies with. If I start niggling about because I think, oh, it's not a great deal and it's 4 times multiple instead of 3 times multiple, and everyone talks about these amazing deals and this isn't as amazing, I thought, let me recalibrate
Yep.
and keep the long term in mind. And I'm very glad I did. Now, hopefully we can get it across the
So
line.
can it finance itself as much as possible?
Yep.
How much profit does it make? Sorry, I know you said... Okay.
So this year it'll be just over 300,000
Just over
EBITDA,
300,000,
and
okay,
then
okay.
next year, because of these contracts coming up and the same cost structure, it'll be about 700,000.
Wow, okay. So on the 700,000, you can go and borrow, say, 2.5 times that. So what's that? 14, 8, so
1.6.
yeah, 1.6, 1.7, and that will fund the next deal. And again, it's just parlaying it up into bigger and bigger deals.
Yeah. Well, my first concern too is to make sure I get my money out because I'm
Yes.
putting
How much are you putting into this?
250.
Are you? Okay.
Yes.
So that's 250 of the 4.
Yes.
Okay. So the other 150 is coming from the...
So there's a 200. They roughly have a 200,000 K debtor book.
Yep.
So I can do 85% of that.
Okay. Yeah.
So the broker tells
Well, that's
me.
why you were absolutely on point.
I was, yes.
What's happening
yeah,
at
yeah.
this moment. Yeah.
And I'm sure everybody will get that through their broker, but there's a few things with that is that it has to be work billed. It has to be in arrears, obviously. No pre-billing or no deposits. They won't, on the debtor book, they won't take any of that. It has to be for work performed already.
Work that's been performed, and therefore the client can't
Build
sort
in,
of...
yeah, exactly. Or you're going to have to cover the cost of doing something in the future. And nothing hanging out over 90 days. They don't want to see any of
Yeah.
that. It has to be aged, but up to 60 days is ideally. And they want to see a sample contract was the other thing. So that's something that I wish I'd known before
And
because I would have asked for that
As earlier.
as earlier. Yeah, as part of that
And
pre-due diligence.
which invoice finance company are you going to?
Well, I don't know who it was. I'm going through your gut, Clive.
Okay, brilliant.
So
Okay.
he's already taken some of the documents, and which
Okay.
was very nice because as soon as I signed heads of terms, I sent him the heads and the latest set of financials, and he came back within a day and he says, "Yeah, I've got 3 possibilities."
Oh, wow.
So yeah,
Okay.
that was good. So
It's pretty good. Very good. Okay, so how can we engineer this to reduce that 250 down a bit? Or how can we refinance the business once you own it? Easier to get finance on a business that you own than it is to get finance to buy a business that you don't yet own. So once you own it, how can we refinance the entire business to release cash that can get you some, if not all, of your money back? So we've got, do you have a mic? You have, brilliant.
Yeah. Hi. We're doing invoice financing at the minute, and obviously the amount they give you, for anyone that's doing it, I would definitely check with your broker before agreeing terms on a deal on what percentage of the invoices you can get for anyone else doing it. Because in construction, you get like 50%, FYI for anyone. But I imagine, I'm not a finance guy, but I imagine a government contract would carry a lot of what's the word? credit-worthiness, because they basically check the credit-worthiness of the company, don't they? And if they've got poor credit, they don't lend against it. I imagine, saying that the government, maybe not, but I feel like the government of most people would be, I bet they would lend, probably, they might lend more than 85%. And if you're getting this new mega contract, you can leverage against that and pull all your money out like 3 months after purchase or whatever, and a little bonus.
When
that
do
work?
those new contracts start to, when are they signed?
Well, they're multi-phase contracts, and they're already in phase 1, and phase 2 starts in another month or so.
Oh, really? And is
So
there
these
anything that could stop phase 2 from starting?
Well, yes, the government could cancel the main contract, because this is a subcontract of a subcontract. You know how these big projects are.
Could you not, thinking out loud, could you not do it where they get X portion if it reaches phase 1 and then X portion if it reaches phase 2? So that you get 250 on day 1, and then if it passes that, and say, well, we'll keep you on as a consultant to help us get that contract for phase 2.
So it's kind of like an earn-out in that they end up with more.
Yeah.
They end up with more when these contracts happen, but they get less to start off with, but they end up with more eventually, okay? And that protects your 250.
Yeah, so we went down, that was the original deal I proposed. Not those exact numbers, but it was, you're spot on, that's exactly where we went. Both of them are staying on as consultants, by the way, they have to, and one, I think, wants to stay on longer, and we'll have to, maybe I might come back to you on some advice on that, but they, one of the directors is 67 now, and he's had enough. He's carrying the can for the majority of the regulatory stuff. He wants to get out of that. So they were quite clear for him. He wanted a bigger chunk up front, because I went down that path, and they said, no, it's a good contract. It's solid. It's about 70% of their income. Okay. So I did try that, and I don't at this stage. I was coming back to that thing I learned about or thought about. Keep the long game in mind. Give them what they want. Let's get this across the line, and then So
just one little tip: if you're going to put money in of that amount, get your solicitor. Is it who's acting for you?
John.
It is John.
Yeah.
Ask for a debenture over the company, so you become the first charge holder over the company.
Oh, well, this is where there's an interesting thing I was going to put to the group. When you asked me if there's anything else, I was going to say.
Is there anything else?
Well, it's funny you should bring that up. One of the things their lawyer has just sent back is they said because of the large amount outstanding or on deferred, they want to put a charge on the shares and the dividends of the company. So my two questions were, is that kind of a normal thing? And if it is, should I be doing some horse trading? So if you want that, then I want more of the deferred to be contingent.
So basically, they're wanting security.
Yes.
And the security they've asked for, to be fair, is not unreasonable. And it could be a lot worse. It could be, they could have asked for security over the holding company, which then affects future acquisitions. They could be asking for personal security from you. So the security they've asked for is actually not, is not over the top. But I think your horse trading is that because I'm funding this deal with my own cash, then I will be taking first charge over the company, and I'm happy to give you second charge.
Okay.
Now, they won't like that because typically you consider the second charge really doesn't have very much value. But I would want to put you in prime position.
Right.
But it's also not the end of the world if it doesn't happen.
Right, okay. Well, so I will go back. I mean, I can go back at this stage with anything. We're not that deep into it. I don't want it to fall over, but I'm willing to let it go if there's anything that's terminal. My thought process was to go back and say, all right, well, if you want that security, then we will make the deferred payments contingent, because there is a small amount of earn-out, but it's very, very minor, and it's capped at £35,000 either way, so it doesn't really move the needle. I might want to go back and say...
It's hard, it's a little bit difficult to horse trade over security, because what they're asking for is almost like, you say, well, if you want security, I want something else. It's like, well, what they're asking for is not unreasonable. a represented seller is going to be asking for that. So, but then I suppose you could ask, I mean, there's no harm in asking for something in return, but I have to think about what could be the most valuable to you. I do it like this. I would say, I'm happy to give you security of the company. It will be a second charge because I am risking my own cash in this acquisition, and my lawyer has absolutely insisted that we take a debenture over the company, but we can put you in second place.
Okay.
So that would be my
Right.
negotiation around that.
Okay.
Anyone want to add anything to? Oh, ta-da. Right. Let's pass the mic forward, please. We'll work it forward.
Well done for everything you've got there. Just talking about the charges there. You say that obviously taking Jonathan's advice, you get the first charge. Will the lender on the invoice finance want to charge over the company as well? Because if they do, they'll want first, won't they?
They will actually, yeah.
Yeah, so this only happened in the last couple of days. I went straight back to Clive, and he's already come back, and I told him the scenario, and he said he doesn't think that that's an issue for the finance.
Wow.
Brilliant.
That was my concern too.
Every lender's going to have different criteria.
Yeah.
And if that's what if the lender doesn't want that, then...
Well, I think because it's specifically a charge on the shares and the dividends, that's how he's worded it, it's possible that that doesn't affect the debtor book, and because it's not an asset.
It does.
Oh, it does? Okay.
Yeah, because a debenture is a debenture, so it's a fixed and floating charge over anything and everything that the company has. Okay. A fixed charge is against for example, the property. So they've got a fixed charge on the property. A fixed and floating is basically everything that the company owns. You can't really take a charge on dividends. I think that's it's just worded in it. I'm not sure that's the correct way of wording it. What it would be is that they would want to restrict dividends being voted until their money's been paid.
I think that's what it is. But
yeah,
the exact wording was
yeah.
The exact wording was, I am considering advising my clients to take a charge on the assets, on the shares and dividends of company.
So they would want any dividend payments of any sort of which is effectively excess profit to pay them off first.
Okay.
But it sounds like it's a business that could pay off all the debt pretty quickly anyway.
If these contracts are watertight, and it depends on the cancellation, because quite often government contracts, it's through a company that's got the big government, the MOD contract, and quite often government contracts will have a flow down, or whatever it's called in Britain, where you have to look after your suppliers to cover,
Okay, great. Thank you, yes.
Hi, are there any physical assets in the business?
Not a lot on the balance sheet, but there is about £500,000. They have a test facility worth about £500,000. The reason most of that's been depreciated. They depreciate it very quickly through the credits, the search or the research credits. And of course, it doesn't have a lot of value out on the market. You couldn't call somebody up and sell it, but it is about 500,000, and there's about 4 million in IP.
Okay, so we have someone in the Inner Circle group who has a lot of IP in terms of. Can someone just help me with the recollection of what this is to do with television rights? Animation.
Is it the Irish guy that lives in Portugal?
Yes, it is. Yeah. Yeah. So, and he's. Am I right in saying he's finding it really challenging to use that as security? I think.
You can't get finance on the IP.
He can't get finance on the IP. Yeah. So it's good for the balance sheet, but it doesn't give you anything, unfortunately.
Yeah, I haven't. That was that the question?
Okay, I've got another little question as well.
Okay.
How many employees are there?
14 with about 8 to 10 contractors on top of that.
I was just wondering if it's possible to raise anything from an employee share issue, potentially, which will just to give up a small amount of shares, but will give them an extra add-in to that business, extra motivation as well.
Yeah.
And you'll raise some funds in the meantime.
It's interesting because one of the, I did go out to kind of do a friends and family round to see if anybody was interested, and my brother-in-law in New York, who was a banker, a retired banker, he jumped on it straight away, and that was his number one thing. He says, I'll float some money to you if you need it. That's fine, but he says, I'm concerned about the employees, what's their end of it. So that's the second time that's come up. My gut feeling is, being this a platform company, I don't really want to give away any equity in it if I can get away with it.
You don't want to rush to do it.
Yeah.
It's an interesting option.
I would, along that same lines, though, I would definitely want, when I get the replacements of the nominated post holders that they currently hold, I would like to give them some handcuffs, golden handcuffs.
Yeah. So again, your accountant can advise on this,
Yeah.
but there's various sort of share option type things that link their shares to their employment. So if their employment ends, their share holding ends as well. The last thing you want is someone quitting and you've still got them stuck in there as a shareholder.
Yeah.
Yeah, great. Yeah, good input. Thank you. Mohammed.
Yeah, hi. I was just going to say, have you, just to be clear, is the growth of the company going from 1 million to 3 million to 6 million?
No, no, it's 6 million total in contracts out over 3 years. So it's going from, before COVID, they were at about 1.8 to 2 million turnover. There'll be 1.7 million turnover by the end of this quarter. Then it's 2.9, 3 million. Yeah, 2.9 million in the next year, and then it'll be 3.1 million.
Okay.
And that's not including what's in the pipeline. Those are just contracts that are actually signed. That's what's in the...
Okay, and so one of the things we've done in the past is we've gone to the suppliers and said to the suppliers, can you fund us going forward in return for a contract over the next 2 years that we'll only buy from you at a fixed rate, dependent on certain conditions. I don't know what kind of product it is, but if you're buying at the spot price, if it's plastic, for example, you have to agree a price. But quite often, if those suppliers are quite large, they want to secure that contract, and they're quite happy to pay you upfront 50K or whatever. I don't know who the suppliers are or not.
Unfortunately, because the nature of it, it's a design and certification consultant. You know, it's
So
essentially it's a bunch of
really low.
bodies. Yeah, the suppliers are not huge.
Okay.
There's not a lot of raw materials.
And just one point on the employee scheme, we've used that in the past. I remember in a software company, and the reason I invested was 2 of the directors remortgaged their houses to come in as part of the deal, and it was, they were very, very super committed to making sure that business worked, and we exited it at a 7x in 2.5 years. So,
it's given me pause to think about those. I've got to look into that. I've got to do some thinking.
Thank you. And just final comment from Steve. Just pass that mic behind you. Thanks. Are you happy with the deal? That's the most important thing.
If I get it across the line at the beginning of January, I'll be over the moon.
Yeah.
But
right.
I'm also being... I'm managing my
moderating your excitement.
I think that's the
get the sign off from the government in terms of secrecy.
Oh yeah, I'm aware. That's why I need to keep them on, to keep managing.
Okay. Finally, Steve.
I just want to share something that may be relevant to you. The employees in the company, are they contractors or are they permanent employees?
So there's 14 permanent employees and 8 to 10 contractors.
Okay. So my sharing is that Jill and I have worked in defence previously. We hold our own top secret level clearances. If any of that staff leave, just be aware it could be months before you actually replace them, because by the time they go through the clearance checks, it could be 4, it could be 6 months. And I just want to share that to make you aware that make sure you've got control over your staff.
No, I appreciate it. I spoke to ADS actually yesterday, the security vetting people at ADS, the Aerospace and Defense people, and that's exactly what they said. Mind you, they do have something where they can actually move them to BPSS quite quickly, and you can get on to certain parts of a contract. That's what they had suggested, so don't know.
Yeah, sometimes you get around it by getting a lower level clearance, but get them off site.
Right.
And they can work off site and limited access and all that sort of stuff. And then as the clearance becomes higher, they can come on site. There's ways around it. I'm happy to share my experience with more during a break if you like, but thank you for...
I appreciate that.
And I have a masterminder from, pre-COVID who, Perry, who bought a couple of businesses that was all about in the same world of government contracts.
Okay.
So I'm happy to connect the two of you as well.
Please, yes.
Let's give this man a round of applause.
Thank you very much.
Well done. Really good. Really good. Okay. Who's next? Tim? Yeah. Sorry. There you go.
How you doing? You all right?
You might need to sit down. Do you want to sit down?
Yeah.
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 Go for it. Tell us what's happening.
So we've been sort of stuck on this. We've been working on it. It's probably 6 months.
Keep the mic
Sorry.
under your chin. That's it.
It's probably been 6 months now when we first agreed heads of terms. It was probably May. Is that 6 months? Yeah, ish.
Yeah.
We're pretty much, the SPA's almost done. Like, I think it'll be finished either today or Monday. Finance will be nailed on next week. We've sort of finally overcome all the issues of not being experienced in the sector. And now...
keep the mic up.
And now we're just... I found there's a property involved, and initially when we agreed the deal, we were going to buy the property. We were going to do it, sort of buy it over 3 years, almost like a lease option style thing. We didn't really want it, and it was in the company, so they could get the entrepreneurs relief benefit from selling the building because they had it and whatnot. And they changed their mind 3 times on that building. So initially they were going to keep it, and then we were going to do a structured sale on it, and then now they were like, oh, we don't want to give you the asset. And in essence, we're now at the stage where everything is agreed, and we're trying to work out creating a lease for the building. And I met with a guy yesterday, me and the sellers, because they own the building, basically, we just sat there and we just agreed with everything in terms of all the terms on the lease, except the only thing they wouldn't do is put it in the SPV. Okay. But we've put it in a sort of an SPV without them. They've agreed to put it in a different one, but they don't know that one's an SPV as well, if that makes sense.
Fair enough.
And they've agreed to it. So that's lovely. For that Beehive thing you were talking about.
Yes.
Yeah. So, and in essence, the whole thing now is just stuck on this lease, and we're just sort of banging our heads. I was talking to you this morning, and probably every day for about 4 weeks. So that's where we're at. So
Lily says, I'm sure we can help. Just tried returning your call.
Okay, nice.
So,
yeah. So, so that's where we're at. I think, depending on how quick she is, because we're going to chop.
Fast.
Yeah, we're going to
She'll
chop.
be all over it.
We've got all the surveys done, searches done.
And that takes the longest. Searches take the longest, yeah.
And the one thing that our lease solicitor did do was actually give us some pointers that I'm resolving with the seller, and he's agreed to everything. So he's redrafting the lease, and I'm hoping it will just be a case of giving it to this girl.
Yes.
She checks it and goes, tweak that, and then we're done.
Yeah.
I'm hoping it will be back end of next week.
So let's talk about that, because what have you learnt about leases that would benefit everyone?
Well, I thought my background's property, so I thought, well, that would be the easy part of this, right? But it just isn't at all. And I said this to Rob. We were probably trying to be nice by saying, oh, yeah, we'll buy the property for you. And we did it in a way that it would be like, no money. Do you know what I mean? And we've not had this conversation yet, but it's like from day one, heads of terms meeting, we're not interested in the property. We'll do a lease. We'll demerge the property if needed, and you can do your own stuff with it. And it will be like that will be almost like the opening line sort of thing. It's like we're not even going to entertain buying buildings anymore. I just can't be bothered. It just can't be asked with it. It's just, in essence.
You can always go back to the landlord later and say, would you consider a sale?
Exactly. So we're just not even going to go down that route.
And that's easier to finance when you own the business, because banks like lending a business money to buy the property that the business occupies, because they just see that as a common sense investment. that has, they understand who the tenant is.
Yep.
They know that you can afford the mortgage and all of those things.
Yeah. So, yeah, in essence, that's what we'll probably do from now
Okay.
on.
So what have you learned about the terms of a lease that would be useful?
Well, firstly, for anyone doing it, I would start the lease as soon as you start the due diligence on the business. I'll just do it straight away. We actually did try to do it because we've done it 3 times on 3 separate structures. But I would just do it almost like, don't think it's quick. It's just going to just start it early doors. In terms of I like to try. I'm a pretty simple guy, and I like to keep things really simple. And this building I was talking to you about, it's tired building, and I went to this meeting yesterday. It was like a 15 minutes. We agreed terms of the lease, right, which was quite nice. And we basically, it was a rule of thumb. Everything that wasn't satisfactory at point of completion is his responsibility. Everything, and you've got to provide me with the documents.
And they've got to put it to a. If there's a hole in the roof, they've got to fix it.
Yeah.
If there's damp, they've got to fix it.
But I said if they don't want to fix it, that's fine. But any damage caused by that, they are then responsible for.
Well, yes. Or they give you them. What were the terms that you agreed?
15 years, 5-year break clause, tenant only, rent review every 5 years, and giving us time to activate the break clause. We are doing any basic maintenance on the building, such as they've got like a aluminium roof and there's foliage growing through. So we'll do basic trimming, but we won't repair the roof. If that makes sense.
So it's not a full repairing and insuring lease.
It's a bit of a hybrid. They wanted that to begin with, and it's a bit of a hybrid.
Well, that's the best for them, because for that moment onwards, they hand it to you, take the rent, and the building is your problem. Building falls down, you rebuild it.
Yes. They're going to get, ironically, they're like an electrical and mechanical contractor, so they're going to give a full service, and they're going to give an updated, is it EICR? The electrical report. They're going to basically get official documentation that everything's satisfactory.
Okay.
And then we will take it on from there.
So it's the landlord's obligation to do an EPC and all of these things. It's a legal obligation to do that. You can cut corners and allow that to follow.
That's what we're doing.
If it's all hanging on this EPC and the person doing the EPC can't get out and do it for 2 weeks. And you're waiting on this one guy to come and look at it. And sometimes these people are just so hard to motivate to come and do something instantly.
Yeah, I said
you can basically say, let's do the deal, EPC to follow.
Yeah, and so that's exactly what we did, because the lease is going to be the thing that holds us up now.
Yeah.
I said that to him. I said, we've spent forever talking about this, and let's not let that hold it up. And he was like, yeah, completely. And the terms are he's responsible for it until he proves it satisfactory. And I said, obviously it's in the best interest to get it done as quickly as possible, but if it takes a couple of weeks, it doesn't really affect me as long as you're paying for it. So it's in his best interest. But we're not going to let the deal stall because he's waiting for the guy to come and trim the hedges, basically.
No. Sometimes you've just got to take a commercial view on it, haven't you? You could say, okay, we could get this absolutely perfect, or we could say, what's the worst that can happen? The trees are going to be trimmed in a few weeks' time and not today.
Yeah. And we have got this because what I imagine is going to happen now is I'm going to agree all the terms with it, like with this guy. We pretty much, like I said, we've done it. And then I'm going to send everything to this girl, and then hopefully she'll say, that's fine. And we've got the ultimate protection of this beehive as a worst case scenario. But the terms, like they're not. There's nothing. I don't think there's anything.
So just bring everyone up to speed on the deal itself, on the business acquisition, then. So give us the key numbers.
Yeah, it's a group of 4 companies. One of them's dormant. It turns over about 9 million, just under 8.5, something like that. Last year was 947 net after the salaries of directors, which is nice.
Oh, right. And what were the directors' salaries?
80k each.
And how many of them?
3.
Oh, right. Nice.
It's got a 2.
Mike, nice and high. So
2.6 million order book. Got 1.2 million.
So is that work in progress? That order
new
book
work
then?
that's coming. That's been
right.
signed up for, and then 1.1 million worth of unpaid invoices within 90 days. Is it within 90 days, or is that in total? Yeah. So anyone who knows construction, they obviously pay. They check for anything's wrong, and then they take money off their final payment. So 1.1 million on unpaid thing, and then they've left 100 grand working capital, no debts, and corporation tax.
So it makes about £1 million.
Yeah. Oh, we're paying 1.96, and we're giving them 1,080,000. Is that 1,080,000 day one?
Yep.
Plus a retained profit after corporation tax, and which is another million. They've got like 1.5 million in the bank or something like
Got
that.
it. Okay. Right.
And then we're giving them 240. I don't know why is it 240 a year for 3 years? 720 over 3 years, basically. It is quarterly, unfortunately. I wouldn't do that again. Yeah, basically.
Okay.
Yeah, so that's the
That's
structure.
pretty good, right?
That's the structure.
A little ripple of applause, I think.
Yes. yeah. So
You don't know what these guys have been through. You've been through the ringer on this.
I'm excited for the next. I'm excited for the next one because I feel like everything that's gone wrong has absolutely gone wrong, and every delay there's been, every possible delay, it's been delayed for as long as possible. And I can't imagine the next. I said to Rob earlier, I said, I can't imagine the next. I think we'll quite enjoy the next one. I think we'll chew the next guy up when we're negotiating and pushing it through legals because it'll just be a bit of a.
It toughens you, doesn't
Yeah,
it?
yeah.
So just one of the things that went wrong that I know about was the corporation tax. Tell everyone what happened with
buggers.
that.
They basically when we first negotiated the deal, we were going to use invoice financing to as the asset and we were working off 85% numbers, which is how we arrived at the 1,080,000. And then all of a sudden, when we actually got to the lenders, we found out they basically give you 50% in construction, especially because the market's a bit wobbly. So that was a bit of a kick in the balls after we'd agreed everything. But anyway, we overcame that, and the way we overcame it was they had like 250 grand's worth of corporation tax in the bank that they were ready to pay for like the end of the tax year in like a couple of weeks. So we were going to use that, and then we were just going to hit late payments on that corporation tax over the next 6 to 12 months because the actual interest rate that you have to pay HMRC is considerably lower than what you would pay a finance company. So if anyone's doing that, it's actually a cheaper way of getting money. But the problem was, because there were delays and delays and delays, I kept saying to him, the longer this goes on, the more likely it is they're going to have paid that bill. And then all of a sudden we get a phone call like a week ago, 2 weeks ago I think it was, saying, because we were trying to get them to write the final figures on the heads of terms, like the specific figures, rather than the formula, so that we knew
in the SPA.
Yes, on the top of it, we're going to pay you this much on day one because this is how much cash is in the bank. So we knew exactly. It was our way of sort of trying to cleverly get them to keep that money in the bank.
Yeah.
And then we sent it over. They agreed everything, and then we sent it over, and then we get a message from their solicitor an hour later. Oh, by the way, they paid the corporation tax like 4 weeks ago, and we're just like, oh, bugger. But we've managed to plug that hole nearly, and in a very, very short space of time. And so we're pretty much there, but we just.
I've been on the other side of this, where on a sale there was a similar amount of corporation tax. It was about 250.
Yeah.
That they actually, the buyer said to me, leave that, we'll take care of it.
Yep.
Which is such an easy thing to say, and the benefit of hindsight is such a simple thing to say, isn't it? And so you'd think that the moment they own the business, it's like, right, sort this out, there's a corporation tax bill of $250,000, let's just pay. But of course they didn't.
Yeah.
What they did is they went back and they refiled our statutory accounts to make that corporation tax liability disappear. And the fastest ways of doing that, let's say, mentioned a couple of times today, £500,000 of outstanding debtors. Well, we could take a view that 250,000 of that may not pay. So you put in a bad debt provision. And of course, as a business of that size, you're using accrual accounting. So so it's not on a cash basis. So there may be work that spills over into the next financial year. So you put in an accrual for that, which reduces your turnover and your profitability. Bang goes, that disappears. The 250,000 corporation tax bill becomes 50,000. Yeah. They pay the 50, and they've got 200,000 cash. Better off.
Well, this is, so we've signed up with Jeff Lerma, right?
Yeah.
And obviously, I feel, and we were literally going to do that, and because he feels like quite an aggressive accountant. I feel like he knows how to be quite aggressive in a legal way, sort of thing. Do you know what I mean? He like with the Portugal thing, and he seems, and we were going to do that, and then we basically thinking, well,
Have you got to go and move to Portugal as well? Is that,
yeah, well, I'm going to move in with you in Portugal. We could,
Portugal.
it'll be, because I saw an email from Rob that floated to him saying, "Can you still do that? Can you still pick it apart?" But I don't know the outcome. But so that basically was a.
Well, you could. Well, you could. You could refile the account.
half of the stuff I don't know.
New accountant, refile the accounts, and say we've overpaid the corporation tax. Can we have it back, please?
I like the sound of that. Yeah.
Can I come up?
Yes, of course you can. Yeah, absolutely. Come to the front.
But in essence, because of the delays on the lease, now that we had a shortful of money, it actually bought us a bit of time to actually plug it, which in a weird way.
So I would be doing that in the background, and if it comes off and you get 200,000 back, happy days.
Definitely a deal.
Yeah, we'd already established that that there's no research and development aspect in the accounts anywhere,
Okay.
so we know that that's a possibility of something coming back.
Yes.
So I spoke to Jeff Lerma and said, well, we've got the completion accounts to do. We'll get those. So I said, do we complete those and then we start the process of unravelling all these other things? He said, yes. He said, research and development, you can go back 2 years. So
Okay.
we can do that, but certainly you get the completion accounts done, so they're happy that that's all cleared off, and then we'll start all this other stuff to start recovering stuff, because then they don't get the benefit of it.
And you do realise what the purpose of the completion accounts is.
Yeah.
The purpose of the completion accounts is to absolutely establish the value of the company on the day you purchased it. And if it was overstated in some way because their management accounts overstated a position, or they maybe thought they could pull a fast one, then your deferred consideration element, the unpaid element, will start to shrink. Or at the very least, you could say, now we've done the completion accounts and rerun the cash flow off the back of those completion accounts. We've got a payment going out to you every quarter. We need to change that to every 6 months or 8 months or 9 months.
I did like what I like to, I'm not sure how it sat with me, but it's growing on me, the idea. Because you said to me, well, pay an accountant and say, I'll give you 50 grand if you can
Oh,
smash
hang on, this was a private conversation. This, but yeah, no, go ahead. Go ahead.
No? Shall I?
No,
Can I?
go.
No? Right.
No, it's good. It's
Oh,
good.
yeah.
That's good.
He said, Jonathan said you could choose if you want to. You can, some people in the past, what they do is they pay a really aggressive accountant to basically smash apart the company on completion accounts, and then you
Your
pay
company?
them almost nothing. He said I could do it if I wanted to.
So basically, look, you can pay an accountant, 500 quid to do something,
Yeah.
or you can say, look, we've got this amount outstanding based upon the company that was presented to us by the shareholders, and we're doing the completion accounts, which will absolutely, now we're in the company, we're not just being fed bits of information, it's now, we're there. We've got everything. We've got access to everything. And now we know everything. What we want to do is make sure that we are not paying a penny more than we should be, and if we are paying more than we should be, we're going to reduce it. So you might incentivize them by giving them a success fee based upon what they can say. I had so many sellers not tell us the truth, like so many. And you think in sort of nice sectors, yeah, everyone's very friendly, but we were lied to so many times. Like for example, with one, what wasn't told to us was that there'd been an incident where a child had swallowed some small ball bearings, and the parents discovered that night in the nappy these ball bearings. Now, that is awful. Who would want to? I wouldn't want to send my child to a nursery where that had happened, because you think that's going to happen to my child. So that was why numbers suddenly dropped, and it was really hard to build occupancy. Wasn't told to us. Of course, it wasn't disclosed. So if it had been disclosed, we wouldn't have bought it. Okay? So my sort of the reason I've got a bit of an edge about this at the moment is because this is those completion accounts are your opportunity once you found all these things to fight back. But they shouldn't be done in 30 days. I'd give yourself 90 days. You bought the business. The last thing you want to be doing is spending time with the accountants. Well, 60.
Yeah, we've agreed on 60. Yeah.
Well, you can be 60 days and you can be late. Yeah. What's the
Yeah.
worst that can happen?
Yeah.
Yeah.
No, I mean, we think that the guys we're dealing with are straight. I'll qualify that in a moment. But we think they are. But there was a point where we said fairly early on, are there any disputes, any litigation or anything like that? We asked the question way before the legal DD, and they said, well, we got one, but it's going through insurance, and so yeah. And they said, no, nothing else. In the last 2 weeks, I've asked some more specific questions about numbers that I've seen. Mm-hmm. Oh yeah, we're in dispute over the amount there. So there was only. It was sort of like I asked the question almost from a legal perspective, what's going on, but on the commercial disputes, they hadn't really told us about it. It's not big numbers, and then it's not a big deal, but it's just like you say, they're just these little things starting to creep out.
So presumably you've got a disclosure letter. So the sellers
that we haven't seen yet.
Yeah, they'll leave that to the last moment. So the disclosure letter says, we stand by all the warranties and indemnities in the sale and purchase agreement, but we are carving out these things that we are disclosing to you. And in the disclosure letter, it's we are being sued by this member of staff, and we do not believe that this particular client will pay. And this contract, we know, is going to terminate in 3 months, those sorts of things. So they disclose all these things, basically to protect themselves from being sued by you later. But the disclosure letter is like their lawyer will be saying to them, be honest. You've got to be honest. If you're not honest in the disclosure letter, it's going to come back to bite you because they can sue you. So they're going to be honest. So that's when everything comes out. That's your last moment chance to negotiate. That's your, when they've told you what all the skeletons are and where they're buried, and you can go back and you can say, right, okay, you've just disclosed it. We can't do quarterly. We've got to move it to 6 months because that's going to impact our cash flow or whatever it might be. Yeah. But how do you both feel now?
Yeah. I mean, it feels like every day we're hitting a new challenge that we hadn't expected, that we thought we'd got past that point.
Yeah.
But at the same time, every day is definitely getting closer. Like yesterday, Tim's meeting is getting it closer. You're speaking to you about a solicitor.
Yeah.
Will move us closer. Just so what that's about, just to let you know, we picked a property lawyer separate from the company doing the rest of our DD, and this property lawyer has just been so slow, so unbelievably slow. And like Tim said, he was going to this meeting yesterday, sent me a message saying, I've sent her an email, do you think that's reasonable? I said, it's reasonable. I said, but you've asked it about a week late. Because she takes a week, she hasn't spoken to us on phone for a month. She won't answer the phone.
I sent her the list.
Sorry, who won't answer the phone? Your solicitor. Your solicitor.
Yeah.
Won't speak to you, or is avoiding you.
Doesn't ring us back.
Oh, it's terrible. That's the most frustrating thing.
We sent her the lease like 2 weeks ago and basically said, look, we need a lease done in 2 weeks. We've got all the surveys and search. Like, can you do it? Like, I know it's tight. And she went, oh yeah, well, if the other side, work with us, it's tight, but we'll be there or thereabouts. We sent her over the copy of the lease and all the survey and searches 2 weeks ago. And the email back I got from her yesterday, well, bearing in mind, we've been calling her for like 9 days on the trot and emails and all this stuff. The email I got yesterday was, I haven't yet reviewed it, but here are some general things you should be asking for ahead of your meeting. And I'm just like,
no good.
So we're going to give it a
Lily
try.
onto it.
But everything else is pretty much done.
But the prize at the end is, tighten your belt for the first 12 months.
Yep.
And then it's a business that could continue to make circa 1 million.
Yeah. Exactly. And it's good because it's quite, because it's like quite commercially large. Where we're doing the buy and build, we've sort of broadly, we've pretty much agreed the next one, and it'll be really easy to bolt in, and because we've got enough money to afford to pay some top you said build your team. This company can afford to do that right from the off,
Yeah,
and then this one can just slide in.
Yeah.
And like we've got an electrician business owner who's coming on as a consultant from day one. That's sort of the condition of the funding. Like this big company pays for him, and we can just send him in all the other ones.
Yeah,
and
sure.
So that's the advice. So it's quite
and what
nice.
I'm really pleased to see from actually all three of these sort of case studies so far today, and then from our fourth as well, it's all million plus. It's all more sizable businesses, which are no more difficult, easier to fund, and you get a better win a bigger win at the end. So, final comment, if there is one.
No, I think that's it.
Thank you. Thank you, Jonathan, for giving us the opportunity, because we wouldn't have been here without you.
You put the work in, guys. Let's give them a round of applause. Thank you. Nice one. Nice one. Thank you. And Alison, and then we'll. So we've got about 6 minutes, and then we'll go for coffee.
Okay.
So you've got deal one over the line. Tell us about what's happened since.
So since then, we have our fourth set of heads of terms signed. And I'm not over $1 million, it's 850,000 turnover.
That's close enough.
So it'll take my group over $1 million because we've had one actually complete, one paused completely, and one, thanks to the lease, is been in the legals for a year. But Lily, I ended up going to Lily after a horrendous time. She sorted it within moments. Literally moments. You're Lily, yes.
Oh, I didn't realise I didn't.
Yeah.
Okay.
So any lease now, I go to Lily, and she's just all over it really quickly.
And by the way, this is not Lily, my 6.5-year-old daughter. this is Lily, the property.
But she's learning too. So again, from letters, it's a guy who's built a hardware shop from scratch. He sold it to Travis Perkins, worked for them for a while, decided he didn't like to do it anymore, so he left them, built this second one up from scratch. And his letter came. He didn't have an intention of selling, but then I think we've seen the letters a couple of times. He thought, well, actually, and then when we met him, we were talking quite a lot about the group, the culture, what we wanted to achieve. And I think one of the things that he's really hit upon is the fact that he's going to be part of other people. And I think that's going to make a difference for him and his wife. He's going to stay on for a bit. His business is in sort of 3 sections. We've got the shop itself, which is about a third of it. Online is a third, and that's an area we really want to get into for all of them. So we thought, actually, we're going to be bringing on somebody who's going to be an expert. And then he also deals with local builders who phone him up and say, can you get this to site? Can you get that to site? So a third of it is product that's being delivered that never even comes anywhere near the shop, which, again, is another sector which we can share with the other one. So when I saw the accounts over the last year that I've been doing this, I've been building a spreadsheet which is kind of like my ideal figures. And he sent me his spreadsheet, and normally the gross profit is somewhere late 40s, early 50s in a hardware shop. His was 26%. He buys so much stuff that he doesn't then sell in the year. That so the deal is all in, stock everything, although we'll argue the toss when we come around to the final year. It's 420, of which he wants 140 on completion. Okay. And then 140 at the end of year 1 and at the end of year 2. By changing what he buys, that money tumbles to the bottom line for year 2 and 3 anyway. And I'd sent the accounts to ABL and said, what can I get on this from day 1 without having to give my inside leg measurement or anything else? And they came back with about 130. So I've asked them to see if they can come back with 140 on debtor finance and invoicing finance.
He wants 140. You can say, you're going to do 130. Take it or leave it. Really.
Well, that came to the point where he would or wouldn't sign. And I thought, for the sake of it, get him to sign and off we go.
But no one's going to lose a deal over £10,000.
No.
That's the thing.
So, but we got heads of terms signed at 7 o'clock on Wednesday night, which was dead exciting, straight to John Andrews by 8 o'clock on Wednesday night, and then had a vodka. So, there we go.
Yeah, very good. we're applauding the vodka. No, nice one. Very good, very good. And lessons learned?
We've always had this approach that we always wanted to just pay between 1 and 2 times EBITDA, and that was it. And actually, because he's got these skills in 2 areas that we want to progress into, and it still is only that it is only still 2, then we've gone to the top end of what we wanted to do, but still achieved it, because he wanted like 3 to 4 to begin with, based on what he had from Travis Perkins. So we've actually chosen to go to our top end to get his skills so we can share it with other people. And you mentioned a couple of times ago about training and development and culture and all the rest of it.
Yeah.
In our industry, we have a big, the spring fair at the NEC in February, and I'd already booked 3 rooms, one for us, one for the one we've already got, and one for him. Although actually, if my second one comes out, then I'll need another room. But anyway, the moment that I said that to him, and I didn't think it was going to be so much him because it's so gifty and he's really tools and stuff, then they were over the moon at being part of the group. So actually, sometimes for the people working by themselves, having the chance to come and work with other people is beginning to become more important than actually the money.
Very good.
So-
Interesting. And so you're building your management team as well.
Yeah.
Yeah.
Yeah, because he would be quite interested in coming into that regional role. And having read a book that you recommended earlier on the year, The Richer Sounds, I think.
Yeah, Julian Richer, yeah.
And he was taking his regional people from managers of his shops to go around because they know what, you know, they know if you're trying to pull the wool over or whatever. And he's really interested in maybe taking on one of those roles. So, so that's quite
Building
cool.
this management team is just, I mean, I've been talking about it, sort of emphasising it to people for a while. Last Thursday, I went to a dinner. It was like an awards evening dinner. And I was on a really good table. I was sandwiched between Tuka Suleiman. If you've seen Dragon's Den the last few years, so I had some Tuka time with Tuka, and the managing director of a private equity firm called All Seas Capital. Now, All Seas Capital were the people who nearly did that deal at the end of last year, and I'd never met the MD. So he walked towards me, you know, coming to find his place at the table, and he said, Jonathan. And I'm thinking, I've got no idea who you are, and I'm sort of going through my data bank of who is this person. And he obviously knew all about the deal. And later on in the evening, he said, would you like to know why we didn't go ahead?
Oh, yeah.
And I said, yes, I would actually. I would. And he said, we didn't know who was running the business. He said it was the management team, or lack of strength in the management team. I said, really, was it as straightforward as that? He said, management team.
Wow, that's good to know.
So
Did you win an
that was
award?
an expensive mistake.
Did you win an award?
No, I didn't either. No.
You're not trying hard enough.
No. But Alison, how do you feel now?
I feel great. I mean, I really do. And we've got another one we're seeing in 2 weeks' time. We've got this other one, the number 2, that's had all the problems because the landlord hadn't actually registered at the land registry because they were trying to cut corners. So that's why that one's been going on for lease. So in theory, in January, I have 2 coming out in the same week, but I'm sure the small one won't really happen.
I'll tell you why he didn't register the lease at the land registry. So he didn't pay the stamp duty. That's what he...
Probably, but now you'll have a fine, which will probably be more.
Yeah,
But yeah, Lily sorted that one in moments for us. She was brilliant. So, and I would always use her again. So there we go. So onwards and off to the next one. There
Amazing.
we go.
Amazing. Thank you so much. Brilliant. That's wonderful. Thank you. All right, so let's take a 15-minute coffee break, and then we'll hit that first exercise when you come back. Okay, everyone, if you could retake your seats, please. I think I will. I need a megaphone. All right, if you could all take your seats, please. Thank you very much. I need to tell you how to do this. Okay. All right. So, thank you for your undivided attention. Okay, guys, if you could take your seats, please. We need to divide the room in half, and it's going to be a lot easier if you stand up for a moment, please. And we're going to get 50% of the room over this side, 50% over this side. So if you do it roughly down the middle here and separate, and then we'll do a quick count to see if we've got two equal groups. All right, so this is our line down the middle. Let's see how we've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. You're throwing my numbers out. 11, 12. Are you on this side? Which side are you on, Gloriana? Okay. All right, so do you want to just step over so I get you in this count? So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, and there's someone sitting here?
Yeah, 2 more.
16? 2 more. 18. We've got 18 over there. Which side you want to answer?
Sorry. No, I was here.
You're 19. You're 19.
No, you've already counted me, so we're still 18. I was just leaving it.
1, 2, 3. This is the hardest part of the day. Counting up to 19. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19. That's kind of, I think it was 19 over the side.
I think there's one outside.
Okay, all right, we'll let them sort themselves out in a moment. So, you're counted, Roger, you're counted. Right. So I am going to give, this is speed deal making, by the way. I'm going to give this side of the room scenario 1. So could you take one and pass it on? This side of the room scenario 2. So you both get an opportunity to be a buyer, and you both get an opportunity to be a seller. And this exercise is all about valuation, what it is worth to you, and structure, how you are going to structure the price and pay the price. So one side is, on this side, you're the manufacturing, yep. So on this side, manufacturing company, on this side, digital marketing company. So 2 different sets of scenarios, 2 different sides of businesses. So on this side is all, don't pass your scenario. You're going to mix the groups. The logistics of this are incredible. So what we're going to do first is scenario 1. So scenario 1, paper holders, you are the sellers. That means that you are the buyers. So you might want to just put your paper away for a moment. You're going to need that in a few minutes, but you don't need it immediately. So you're the sellers. You might want to start reading your seller brief now. And you are the buyers. Buyers, you don't really know what you're walking into here. So you are going to be asking lots of questions to find out information. You will need a pad and pen because you want to be able to write. There's lots of numbers, so you want to be able to write things down. And you are going to start thinking to yourself, what is this business worth to me? How would I structure the deal? How am I going to finance the deal? Okay? And what I want you to do by the end of your questioning and your conversation with the sellers over here is I want you to determine the price that you'd pay, the structure, how you pay for it, that sort of information. And I want you to put that on a blank sheet of paper. There have been pads on the table, I think, since this morning. And because I want you to be handing that piece of paper to me later with your name on it so I can identify what you're going to pay, how much you're going to pay it, and how you're going to pay it, okay? So that's what we're going to be doing over there. And then we're going to swap, and you guys are going to do exactly the same, and you're going to be the buyers of the digital marketing business. So now we need to pair you up, and it's better if you do this with someone that you don't know that well, rather than your best friend in the group, okay? Because I think you become tougher negotiators when you don't know someone so well, okay? Now, how we do this is going to be entirely up to you, but you need to do it quickly. And then once you've found your partner, you are going to either stay in the room, some of you will stay in the room, or go down the corridor, downstairs. You've got all that seating just in front of the restaurant, maybe go through to reception, but just somewhere where you're not shoulder to shoulder with someone else, because you also don't really want to be overhearing what the other people say, because you don't, you want to make this a fair negotiation, okay? How long have you got is a very good question. So, 15 minutes either way. 15 minutes, okay? So that means you're going to be back here, please, in the room for 12:30. That gives us 30 minutes of what did we learn from it, how did we do it, and what would you do differently if you were to do it again? Is everyone clear? Not... Say again?
Are you saying we switch sides at 15 minutes?
Correct. You switch sides at 15 minutes.
And we must close the deal.
Well, it's not about closing the deal. It's about reaching a price and a deal structure. So I suppose, yes, you're closing the deal. But you end up with a piece of paper. So just to be clear, when you come back here at 12:30, I will receive a piece of paper from each of you with your name on, whether it was digital or whether it was manufacturing. That's the other important piece of information. And the essentials about this deal. How much you're paying for it, how you're structuring it, how you're funding the payment. Okay? Because I want those up here because I'm going to be picking some out and reading them out. So I need to have them. With your name on, please. Not someone else's name. Your name. Right. Everyone clear on that? Well, same person. Yes, thank you. Same person. It would be way too complicated to move everyone around, trust me. It was hard getting to this point. Right. Okay. You've got 35 minutes starting now. Off you go.
Okay.
This, which one was this?
Oh, sorry, that is the
Just
manufacturing.
No, just put man on. That's fine. That's fine. Then I know which one I'm talking about. Brilliant. Thank you. Two more. Thank you.
Oh, yeah.
Digital. Yeah, got it. Brilliant.
Wow.
Thank you very much. Digital. Right. Appreciate that. Thank you.
Okay.
Oh, you got that for me?
Happily,
Yep.
that's my name, but this is the purchase structure. That was just the information.
And that was number 2. That was the. Was that the is that
Scenario 2, digital.
digital? Yeah. Thank you. Well, let me make sure it's on that side. Yep. Thank you. Scenario 1.
I'll tell you about it later.
Thank you. Digital 1. Are you guys done? Are you wrapped up here? Thank you.
Right, if you can read it.
Thanks. And that's digital.
My handwriting, no way. I've got like a 5-year-old, yeah?
Thank you.
That's what it is, yeah.
Thank you.
Fine, it is what it is, you know. Just let me know if you need me to read it out to you once you...
Can I have yours, please?
Right down the back. Oh, what's the right side?
Any way you want. Piece of paper, anything, anyway. Thank you. Alrighty. If I haven't got your paper, I need it now, please. Thank you. Thank you. Thank you very much. I'll take that. Thank you. Oh. Manufacturing, digital, manufacturing. Thank you. Was that that is manufacturing number 1? Yeah, perfect. Thank you. Okay. Do you want to swivel around a little bit so that you can see what's on the whiteboard at the moment? Okay, right, if you could take your seats, please. I should have a piece of paper from each of you. If you could take your seats, please. I should have a piece of paper from each of you. If I don't, could you give it to me now? If you haven't given me a piece of paper, I need it now, please. Anything over here? Did I get yours, Gloriana?
No, you didn't, because I'm not submitting one.
Sorry, say again?
I'm not submitting one. It was an incomplete record.
You're not going to give it to me?
No, and to put an offer in with so little information was records.
I'm sorry?
To put an offer in with so little information.
You're not putting in offers in. Yeah. We have a complaint. We have a complaint about the insufficient data. Let's not take it too seriously. Right, guys, make sure you put it in the right pile. Make sure it's in the right pile.
Yeah, this is one that one.
Okay. Yeah, 1 and 2. 1 here, 2 there.
That's buying the digital, isn't it?
Yeah, it is, yeah, perfect.
Why the manufacturing here, no?
Perfect. Okay. Ollie, where's Ollie? Ollie, were you manufacturing or digital? Which one? Got it. Okay, guys, right. First of all, what I thought was very interesting is the different approaches people took. Is the different approach... What are you doing? What are you looking for? What do you think is in that cupboard that you're after? A pencil. All right, come on. Right. What I thought was interesting was the different approaches to that. And I think what it immediately shows is how people approach things very differently, which is a good thing, that we're all different. But what we've come up with then are some very different outcomes as well. So with the digital marketing business, what were the pros and cons of this business? Let's start with the negatives of the digital marketing business. Yes. So let's move the mic to the back table. Could you just pass that behind you, please? Right. So negatives of our digital marketing business. Is our mic on, please? Thank you. Yes, go for it. Go for it.
There are no assets that you could
Sure.
that you could leverage against. There was the property, and the other thing is that he's the main salesperson, so there was a risk.
Yes.
Plus, you needed to do some add backs for sales to hire a salesperson, so there's an extra salary to include, and there's also rent because he owns the property. And I was presuming he was owning it outright.
Yeah, no, absolutely. So
And no contracts.
So, so the intention was that the buyers would ask lots of clever questions to uncover this information, and it isn't given up too freely by the seller. A couple of occasions, the seller was actually just reading the information out to the buyer, which is very helpful, very helpful sellers, which sometimes you have, which sometimes you encounter, don't you? You have a helpful seller, which is interesting. But the idea was that you, as the buyer, would ask the questions about the business to uncover the pertinent information. And you're absolutely right. There was a property owned by the seller in the digital marketing business worth $250. But the seller was the main salesperson, which meant that there was a massive point of weakness in that business. And this is a classic: if the seller leaves, what happens thereafter? Did we discover the motivation of our seller in the digital marketing? Stress, absolutely, yes. Now, on the plus side of our digital marketing business, what did we like about it? Okay, so who'd like to go? Hand up so I can pass the mic to that table. Could you pass that behind you, please, to Ian? Thank you.
I thought the salary plus dividends was quite good. That there was a lot there.
Sorry, we're talking about the digital marketing business.
But yeah.
Yeah.
The 800k plus dividends. Oh, 8k. Oh no, that's right. Sorry, then I read that wrong completely. I was luckily the seller.
Again, thank you, Ian. I appreciate you doing that on purpose to illustrate the point that we can sometimes get numbers wrong and have a misunderstanding. So presumably then, the deal that you put together in your head for this business...
I was the seller.
You were the seller?
I was selling the digital business.
So did you give that information to the buyer that you draw £800?
He didn't ask for it.
He didn't ask for it, okay. But if he had asked for it and you'd given that information and got it wrong,
that's
you see how
bad, yeah.
the buyer would have gone down the very wrong path in terms of what was being drawn from the business. So, Ian, something that's good about this business, apart from the salary that's being drawn.
Well, cash in the bank is good.
Yep, good cash at bank. So, so buyers of the digital marketing business, did you uncover how much cash there was at bank? Yeah, you got the 500. Fantastic. What else, Ian?
The property worth 250,000.
Yes.
And the COVID loan.
Okay. And why is the COVID loan good?
Well, that's money I could probably use to buy the business initially.
You can contribute to it.
Yeah.
On a low interest rate.
It's something that's available, and if I don't need it, it's not a lot, but there's something there.
Okay, great. Someone else on the digital marketing business as a downside of this business, a negative about the digital marketing business that we haven't mentioned. Could you pass the mics back? Keep that mic at the back of the room. Pass that one in, please, up to the front. Yes, Roger. Tell me and I'll tell everyone.
There was no contractually...
yes, say that again for us.
There was no contractually recurring income.
Yeah, so there were no contracts. Quite typical, actually, with digital marketing businesses, which means that, potentially, you buy the business and every customer walks and there's no long-term contract to hold them, or contract at all. Yeah, great. Anyone else? Something different, or are we going to say the same? So who at the mic at the back? Was that the same for you to say the same? Brilliant.
The fact that there's no recurring income at the present time gives you scope for how you could build the business in the future by getting some recurring income contracts.
By contracting the customers? Yeah, absolutely. Well, it would give you an easier outcome in the future if you were to do that. Just pass the mic across, please, to Gillian.
This is actually more of a question which was put to me, and I know you've answered it in the past, but if you could remind us, my seller said to me, well, I'm the salesman, and if you don't employ a very good salesperson, then why should I suffer? Because I said about an earnout. So what's the answer when they say, when you say, or they say to you, yes, why should I suffer if you don't run the business very well after I've sold it to you?
But that's why we're maintaining you on a handover and consultancy agreement to make sure that we follow the right lines. We want this business to be successful. Okay. You help us make this business even more successful. We benefit, and if we benefit, you benefit. No one has any interest in running this business into the ground. Why would I buy a business and then run it into the ground? I want to build it up. And I'm sure with your experience, knowledge, and expertise, and our sort of renewed enthusiasm, and you don't have any of that stress anymore, between us, we can do that, which means that you get what you want, we get what we want, and everyone's happy.
Thank you.
Ta-da. There you go. Right, okay. So let's talk about values and structures for digital marketing. Okay. So you're all presented with the same information, but interpreted it differently. I won't do all the names, but I'll do the amounts. We've got a 2.5 million purchase price here from, actually this is from Steve. Where's Steve? Steve, yes. Which works out at initial consideration 750 in the first year, deferred consideration 4 years at 500,000 a year. Okay, I think we're going to see some similarities here. So what we've got then here with Ollie, we've got a price of, Ollie, can you?
2.6.
2.6.
250 up front, sell the property, but do an earn-out based on EBITDA.
So yours was structured on the earn-out,
Yeah.
So that if...
Subject to EBITDA,
yeah, so if EBITDA performance went down, outcome for the seller went down. Thank you. Dan, we've got you in at 1.8, is that right?
Yes.
Yes.
Well, I've put a range there starting at 1.82.
So you felt that if it was 1.8, it would be good, but you went up to 2.7. So somewhere in that range, you'd be comfortable value to you. Okay. We've got David.
Oh, which David? David Williams?
David D.
Oh, that's me.
David D, you came in at 3 million. Yeah, okay. Kirk, no, sorry, Kerr.
Yeah.
Kirk, 2.25. 2.25. We've got Charlie at 2.6. Reasonably similar, these numbers, aren't they? We've got Glenn at 2. We've got Rob at 3.75. David at 2.6. Gillian at... Is that 2? Yeah. I thought it said 20 for a moment. I was trying to make all the numbers add up to how we got to 20. We've got 2.4 from Alison. We've got Neil at 8 million. Wow. Okay. Let's find out. Microphone to Neil. So Neil, how did you justify that? I'm not saying it's wrong, but how did you justify it?
So I trusted the vendor, and I was reliably informed that a multiplier of 8 times was standard for the industry, which I didn't know to be true or false. The point was he was going to get £1 million on day one, and then 50% of profits annually thereafter until the 8 million was paid. Therefore, if we didn't make any sales, then he didn't get any money.
Okay. So there wasn't really a huge. So really, you might have ended up just paying one. But the idea is that you want a successful business. So the chances are that you would pay a lot more than that initial one.
Yes.
Okay. But effectively on a risk-free basis, because if you don't get it, you can't pay it.
Correct. Correct.
Okay. Interesting. Good stuff. Yeah, no, that's great. Thank you. Stephen, coming in at 4. Where's Stephen? Quite strong position on that one.
Yeah.
Justification. Oh, you've got the mic next to you, I think. Yeah.
I think it's just about getting the deal over the line and looking at refinancing that for whatever's deferred and then chipping away that price down over time. So make it look more attractive to the seller initially, but then renegotiating a year or so into the deferred.
Okay. Okay, yeah, I understand. Amir is in at, you've got 2 numbers here. Where's Amir? 4.5 and 5.4. You got the wrong one? No, that is digital. Well, it's on the back of the digital paper anyway. Don't worry, we'll put that over that side. No problem. You nearly bought yourself a digital business there. So, Hanif, we've got 3.5. And then Sarah, we have, is that a straight 2? Okay. I think that's everyone. Right. Well, that's everyone that I had there. So what have we got here? We've got a variance from 1.8, I think, at the lowest end, up to 8. We've got a lot around 2.6, interestingly. We've got 3, 2.6, or 2.5. Quite high at 4 and 3.75. We've got some 2s. So there's quite a variance there. Here's the question. Who's right and who's wrong? What is the correct price for this business? It's what you can pay for it by financing and what it's worth to you. So if you're buying this business as your first investment, your first business acquisition, it might be worth more to you because you want to get that first deal over the line and that's your strong platform going forward. However, if you already own a digital marketing business and you know that you can immediately cross-sell the clients of the target company with the products of your existing company, then the value goes up. Alternatively, it could be an acquisition that you're looking at, you're not actually not particularly interested, it's more opportunistic, and therefore, if you can do something right here at the low end and get your hands on that business and it does well, then that's great. So you're not so committed to the acquisition. So we've got an incredible range. What were our key financing methods then in this non-asset heavy business? What were the key methods? Just call them out rather than passing the mic around. Cash at bank.
Vendor finance.
Vendor finance. Remortgaging someone's, putting finance on the property. Yeah. And the debtor book, to a certain degree, if there's no contracts with those debtors, that could create an issue with the debtor book. So those were our sort of go-to methodologies, and you did some combinations of those. Now, we've got more options with our manufacturing business. So I've got yours at the top. Was it 4.5 or 5.4?
5.4.
Which one would you like? 5.4. Okay. So we've got a 5.4. Harry, we've got you at 6. Roger, we have that at.
Well, you could say yes. I thought 8 was too low, but just so we could move on to the structure of the deal, we pretended we have agreed
I've got 3 written down here. Is that right? Yeah. Okay. That was the digital. Sorry, it's in the wrong pile. Ignore everything I've just said. And yours is the manufacturer, and you've got 8. Okay. We've got Charlie at 10. Where's Charlie? At 10. Patrick is also at 8. We've got another 8 from Felicia. Is that right? Was it 8 for you? Yes. We've got Ali coming in at also at 8. Interesting. Lee, we've got 9. Talat, we've got 4. Philip, 7. Julie at 5.5. We've got Ian at 5. We've got Jeff at... Jeff, can you remember? Was that 8? Yeah. Jeff at 8. Interesting. We've got quite a few 8s coming on here. We've got 6.5 from Adrian, I think. Sorry, Tim, I got that in the wrong pile there, which is why I didn't mention it earlier. Khalid, we've got 5. Tim, yours was... Tim was at 10. We've got Nick at 8. No, Nick at 6. And we've got Christina at 3. All right. Okay. So look, we've got a variance from 3 to 10. Okay. So again, who's right and who's wrong? So when people say, how much is this business worth? You all did a how much is this business worth exercise with the information that you had available, and you got to this variance of numbers. Now, again, that means that no one is right and no one is wrong. But how do we finance this business based upon the information that you were given? So do we have a mic at the back there? We're going to find one. There it is. Phil?
Right. I would finance the assets at 70% loan to market value.
Yep.
I'd use the 500k that was in the bank account. I would give them that as day of completion money. So that should be, off the top of my head, it should be about 2.6 million. And then I would pay the other 4.4 over 4 years, it's 1.1 million. So in effect, I'm making...
which is 50% of earnings, yeah.
Which is more or less 900k in my pocket every year and 1.1 million to the exiting owner.
Round of applause. Very good. Spot on. So do you see the thinking behind that? How can I use what the business already owns and leverage that? None of your own money going into that whatsoever. And you still have a business that during the period of the deferred, which is how long did you say? 3 years. You still make 900,000 a year.
4 years.
4 years. Still make 900,000.
Yeah.
Okay.
Each year.
Here's the thing.
You make 900,000.
Question for you. What if the seller was absolutely adamant that he didn't want to do it the way that you've described, want all the money up front? What would your answer be?
No.
And then what would you do next?
Walk away.
Exactly. So again, we're answering the question that does get asked quite a lot in the LinkedIn group when people say, how do I make this deal work? If it's not workable, it doesn't matter. There isn't an obligation on you to make every deal work. You've got to find what's right for you, and what's right for you is a completely de-risked acquisition using other sources of money rather than your own savings account. Okay. We have a question, but we need a microphone. Okay. Can we pass the? They still won't hear you at home if you shout.
I think he said he's going to use the cash in the bank as part of the initial consideration, right?
That is what you said, Philip, right? Yes, it is.
Okay, so for the business with 47 staff, I personally am not comfortable to do that because I will still need to have the cash in the bank account to pay for the ongoing businesses. That's why I think.
Yeah. So did you discover that there is currently an overdraft?
Yeah.
A 250k overdraft. There's a property of 500k that you can go and get finance against. So you've got working capital.
It takes time. But by the time you're going to mortgage the property, it's going to probably take you over, I don't know, 2 or 3 months. And you need the cash flow. You need to have cash in hand.
But you do that on completion.
You do it in obviously, as the due diligence is going on, you've already got your finance working at the front end. Know what I mean? So see, come the 2 months or the 3 months in which the due diligence takes to complete, everything will be in place for day of completion.
Mm. So you use the money from the finance of the property, and you're going to use the cash in the bank as well, or you're going to keep that?
The cash in the bank goes to the seller to make up their day of completion money, right? So then I refinance the land and the buildings, right? That releases me, I believe, about 75%, with a 25% deposit down. That releases me roughly about 375. That's working capital moving forward.
Okay. So you close the deal using the cash, and in the meantime, you start the process with the mortgage.
Yeah.
Okay.
You start the process of the mortgage right at the beginning of the due diligence, because that's the longest part of it. That's the longest part of it. By the time they dig into who you are, what you have, into your business plan and everything else, it's all time consuming. But you do that at the very beginning of your due diligence process.
Don't complete until you've got your finance ready to go.
Yeah, makes sense.
Yeah. So as Jonathan says, you might get 10 deals to heads of terms, but you do them when you're ready to do them, not when the seller's ready to do it. So you stage it in as and when you're able to take time to complete on that deal and do the integration.
And I've got to say, Phil's attitude towards that is absolutely spot on. It's my deal, we do it my way. If I can't make it work my way, I've forgotten you that instant and I'm on to the next. Okay? Rather than, how do I make this work? Trying to force a deal to happen that just wasn't meant to be.
No point in wasting time, is there?
Yeah, absolutely. Just pass the mic across to Steve, please.
I just want to raise a learning point, if I may. So you've got some assets in this deal of 3.5, and you've got the factory at 500. Which one do you actually go and get finance on first? For example, the assets probably depreciate over time, whereas the factory probably appreciates. So just from a learning point, would you get finance on the assets first so that you're getting the highest value today rather than see them depreciate over time?
I mean, well, Phil, you give your opinion, I'll give mine.
The depreciation only happens at the year end. So doing it within a couple of months isn't going to make it depreciate any further unless they're depreciating it on the management accounts on a month-by-month basis. And nobody does that, being honest. Know what I mean?
Well, because they're not running a balance sheet every month.
No, they're not running a balance. It's every year the balance sheet's done at the end of year. That's how you get your balance sheet, the cost, the depreciation, and the net book value that's left.
You could use the microphone.
If you can finance it in other ways at the beginning and save the assets for, say, year 2's deferred consideration or year 3, whatever, then you're not dealing with end of year balance sheet value. So we're still saying no.
But the balance sheet value is irrelevant to what the lender will values it at.
Okay, yeah.
So the balance sheet. So they might be depreciating the property. They might be depreciating the assets over 4 years, but they've got a very good lifespan of 10 years. So in 4 years' time, those assets disappear off the balance sheet because they have no value, but you've actually still got them operating in the factory very nicely. So to answer your question, which would you do first? I'd do both at the same time. I would want a finance offer on my assets and also on my building or on my they were the two things, weren't they? Yeah, the manufacturing assets and the building. I'd have them ready to go, because if I can use that to buy the business and release cash to buy business number 2 or to pay myself a deal fee, then I'm going to do it. I'm not going to wait. Why wait?
Okay, thank you.
And the stress of getting finance on one thing, you might as well have the stress of getting finance on 2 at the same time. Any other observations on the manufacturing business? Anything else anyone else would like to add?
It's long established.
It's long established, yes. Can be good and can be not so good.
Joint owners.
Say again?
The joint owners.
Yeah, joint owners. With joint owners, you want to get them both to the meetings. Tim, grab the mic. I think you've got it on that table already.
One thing that we flagged, it's an old management team, which obviously just instills a bit of risk, because if you're retiring and then you think, well, we've got a great management team in place, but if they're all the same age as the seller,
well, one of the red flags on here was the good management team, although some are coming up to retirement age.
That's what I mean. Yeah, that's just it just sounds like an excuse to bring the price down, really.
Yeah,
I think.
Great. Final point here, and then we're going to break for lunch. You got the mic? Thank you.
Just at that level of profitability, would it not make sense to flip it straight away to a venture capital fund?
Well, the challenge is by itself, even though yes, it's a profitable business. You mean you buy it for one multiple, sell it for another multiple?
Well, it's over $1 million. It's 2 million. So is that not sellable straight away to a big fund?
But you probably would want to polish it up a little bit, professionalize it. When you've got older owners, they tend to do things, paper-based, not really using the latest technology. Maybe not pushing too hard. You could grow the business quite quickly by putting in a more aggressive manager. And then if you could use the financing from that business, raised off that business, to buy business number 2 and slot that together, in a 12-month period, you might have something that's way bigger, way more valuable and professionalized. And on that note, let's take some lunch. Could you be back here, please, in about 55 minutes at 2 o'clock? See you shortly. Shortly. So I thought in the meantime, we could take this opportunity to do a little bit of Q&A on anything that you'd like to ask a question about. Right, okay, we got a question at the back. Where are our microphones? Are they here? Okay. So, would you mind just passing that behind you, please? Thank you. Gillian. Hi.
So, I disagreed with you initially about Plimsoll, but since I sent out a whole load of letters and the people I've been speaking to, the Plimsoll data is very wrong. So, who do you recommend these days?
Who might have said that?
I know. But I had.
Everyone needs to prove it to themselves, yeah.
Well, I'd already bought it, to be fair. I had already bought it.
Plimsoll has a reputation for being very inaccurate.
Yep. So who do you recommend these days for data source?
So what is it? Tell us what you want. Tell us what you're after.
Okay. So I'm looking for fencing companies who are around the million plus, could be a little bit lower, but definitely have at least 5 staff.
Okay. So when you say fencing, are there businesses that just put fencing in?
Yes.
Yeah, there are.
But
okay.
they do all sorts of different
So
types.
this isn't going to do my garden fence, is it?
No,
you're looking for some
security fences, commercial fences.
For protests. Yeah. Okay.
So what I'm particularly after is data where you can pick out the ages and the number of employees and that sort of thing.
So your feeling about how many businesses like that are in the UK, what do you feel? There's not going to be thousands, are there?
Yeah, probably.
Doesn't feel like.
Probably about 8,000 or 9,000 easily.
Wow.
The problem is that you've got to differentiate between the one-man bands and the companies. But once you get companies, and I've been looking at limited companies, they tend to have more employees.
Well, yes, because if you are a sole trader, you are your only employee. As soon as you start employing people, you would go to an accountant, and the accountant would say, well, you need to set up a PAYE scheme for these staff, and also you need to be incorporated. So that's probably is the tipping point from sole trader, self-employed to... So really thousands of companies that do fencing.
There's
Amazing.
a lot.
And if I went to the Yellow Pages, remember that, the Yellow Pages, and would it be fencing companies that I'd look
Yes.
for? It is,
yeah.
okay.
Because my first mail out I did from just going to 192 and the counties that surround where we live, and I got over 1,000 just in the 5 counties.
And so what was wrong with that? Was that...
I only got 2 people out of the 600 that I sent, and one worked out until we got close to head to terms and fell over. But that really made me realise how many were just single installers. So that's why I went to Plimsoll, where I could at least look at the limited companies.
So you haven't been to Market Location?
Is that a data source?
Yeah, so Market Location is...
That's the answer I'm looking for.
Yeah, so I just wanted to understand what you've done already. So Market Location is where just about everyone, I think, gets their data from, well, anyone that I recommend them to.
Right.
So they will be able to provide you with some sort of segmentation, but you've got to realise that it's all it's all run through an algorithm. Okay, so it's not going to be absolutely dead accurate, but that is just the nature of any sort of data set. I mean, goodness me, if there was a source of 100% accurate data, we'd all use it and no one else.
I guess, thank you, because when you've got things like electricians, plumbers and such like, you get companies, and same as fencing, you get companies of a decent size, but then you get a huge number who are single sole traders. So being able to do at least some segmentation does help.
Or you say, well, if I can't segment, I've got no choice but to mail everyone.
Which is what I did in the first place.
Yeah.
It's less about the source of data, it's the reliability. So when we've had a couple of people ring us up, and the guys have said, oh, so we understand, Jill will say, I understand your business is about $1 million. Oh, no, it's nowhere near that, $500,000 at best. Or the other way, oh, no, we're about 3.5 million was the other one, wasn't it? So how can you rely on that data that's coming when it's that kind of...
This is not a new conversation. So I started doing direct mail in business direct mail in the mid-90s, 95, 96. And if I was with a group of business people back then, 28, 27 years ago, it would be exactly the same conversation. Because, so I would rent all these different lists. I would rent, I'd go to a magazine and get their subscriber list. This is all direct mail, there's no email. I'd get their subscriber list. I'd go to the Yellow Pages, go to Thompson's, get theirs. And then I'd chuck it all into, actually I wouldn't email it, I'd probably put it on one of those discs, those square discs, send it to the mailing house, and they do what is called a merge and purge. So they merge it and then they purge out the duplicates. So you end up with a master list. But you still have, I would have my team complaining about, oh, these people are time wasters, and these people are too small, or these people are too big. And, well, so what? We're still turning over millions of pounds a year as a result. So that's just, yeah, it's like someone in the old days of selling encyclopedias door to door, going back to their boss at the end of the day and saying, goodness me, half these people don't want encyclopedias. And other half, they didn't open the door to me. No, well, yeah, but how many sets of encyclopedias did you sell? 2. Well, you hit your target, right? That's you did. You did really well. Don't worry about the 98 that said no to you. Let's focus on the people who say yes. So if I want to buy a business, for example, so I'm looking straight at you, so looking at the business that makes nearly £1 million a year, all right, I only want one.
What I've found, though, is that with the fencing industry in general, they're not hungry. So it is finding that needle in a haystack where they do want to retire or they're ill.
You're right.
So I'm aware that it is going to take a lot of mailing to find that one. But I was just interested really in a different data set.
Yeah, so I mean, you can go to the sort of, I mean, I don't ever put much, credit safe, Experian data. It's all rubbishy. It's not. It's all sort of the company's house records. They don't care. They tell you that the quality of the data is important to them. Of course, they have to tell you that. They don't care because you put your credit card in and you've got your data file, and they'll never speak to you ever again. They don't care. Where if you go to someone who does care about your return business, your repeat business, there's actually a human being who makes money if you come back. It's their job to get you what you want. So let's say I was looking for dentists. I'd go to the Dental Association, see if there's something on their website, and let's say they had a list of all their members of the Dental Association on their website. Fine, I'd go into Fiverr.com and I'd say I'd find someone on Fiverr.com who could scrape that data and put it into an Excel spreadsheet for me. And they do it while I'm sleeping because they're in Morocco. $20 later, I've got the job done. I'm actually wondering whether there are fencing associations.
I haven't found one, but I have found a fencing training company that trains people, and I am wondering whether I could contact them.
Yeah, I phone them up and say, hi, I'm looking to buy a fencing business. I just wondered, where do I get a database of all these fencing companies? Where do you get yours from? And they might say, oh, you just go to this person over here. They'll do it for you.
Okay.
It's simple as that.
Okay, thank you.
Sell you them
or study their mailing list. Absolutely,
That's
absolutely.
true.
It's a really good question. But you're constantly on the hunt. On the, you know, for example, let's say there is an exhibition for people in the fencing. Where they're going to see the latest fence panels. Sounds thrilling, doesn't it? And you go to the exhibition organisers, they'll rent you the data.
Okay.
Yeah, it's a oh well. You could become a proud member of the Association of Fencing Industries.
Oh.
The Industry Association. May I just click on that just to see what it is?
I did find one in the States. I didn't find one in the UK.
Have you found the same one?
Yeah, I'm just seeing if it's got a member list.
Sometimes they say how many members they've got, don't they?
Yeah, I'm just clicking through.
But what I'm saying is that was seconds.
Yeah.
So it's out there.
I thought I'd done that search. I'd only got American ones, but maybe it's picking up my Australian
IP address.
IP address.
Yeah. Good.
I know that the
hang on, we need a microphone, otherwise people at home cannot hear.
You could look at sort of the Federation of Master Builders and stuff and look for the category of fencing and take that out.
Yeah.
So some of them will be with different associations and look at that.
Yeah, absolutely. So it's a little bit of detective work, really. Where are the people that I want to get in touch with? Where are they? How do I find them? And then just go on the hunt for them.
Thank you.
You phone up a couple of local fencing companies, or fencing companies anywhere, I guess, and say, look, I know this is a bit of a strange phone call, but I'm interested in buying a fencing company. That's not actually why I'm phoning you. I just wondered, where would I find a list of fencing companies? How do I find all of your colleagues?
Actually, that's a really good idea, because the people who are coming back to me from my mail out, they're not actually interested in selling their business, but they're intrigued by the letter and they just want to talk at this point. They're not motivated.
It's a very lonely group of people.
Yeah, I think it is. But they're not motivated to sell because they've all got too much work.
They just want to phone for a chat. Okay. Are you okay with that, Gillian? Is that helpful? Yeah. Okay. All right. Hopefully helpful to everyone as well. Right. Okay. Let's talk numbers. So I want to introduce you to Joanne Bell, who has very kindly agreed to come here today to talk about the understanding the. How are you?
Oh,
you good?
Yeah. From my terrible journey.
To understand the numbers behind a business, and also Jo has bought 5 businesses, 4 of them accountancy practices, and you are currently the holder of the prize for the longest deferred payment terms on a deal of
20 years.
20 years. My goodness.
No one's ever given me a round of applause for that before.
In fact, actually, if you could just mention to everyone a little later how you did that and how you negotiated that deal. So I'm going to leave you in Jo's capable hands. I think another round of applause, please, for Joanne Bell. Thank you.
Thank you all for having me here today. Really excited to meet with business owners interested in buying. That's definitely sort of my speciality as an accountant. And I think it's probably important to point out that not all accountants necessarily know about the process of buying businesses, things like that. It is relatively a specialist area, and I've definitely found that the biggest learnings for me have come from the process of actually buying, rather than what I would learn in accountancy college, if you know what I mean. So hopefully if I can share that with some of you today, that will help. One of the things that I probably became aware of quite early on when I started out in business is that I'm not sure I would have even set up a business had I not been an accountant, let alone bought one, because that would have been the thing that would have scared me the most, thinking about, what are my responsibilities to Companies House, HMRC, all of that sort of thing. So the fact that I sort of had that knowledge was definitely helpful, and then sort of buying a business is next level again, what with all the due diligence and potentially financial risk and all of that. But yeah, hopefully we can unravel some of that for you today and make it all a bit clearer. So, things I'm going to tell you today. I'm going to tell you a little bit about my story, so how I started out and all the things that have happened since then. Understanding accountancy jargon. So you've probably heard a few sort of phrases knocked around. If you have a business currently, you're obviously talking to your existing accountant. You might not be familiar with all of the sort of technical phrases that we use, so I'm going to try and share some of that with you. The process of valuing a business can be quite complex, can be quite simple. There's kind of a lot of grey areas, so even if I can just give you some pointers as sort of what questions to ask and what things to look for, hopefully that will be a useful exercise for you. How to structure a deal. So as Jonathan mentioned, I've done this a few times myself, predominantly in the accountancy world, and obviously each industry has its kind of own standards and things to look at and ways of structuring those things, but there are some sort of general rules which we'll cover off. And finally, how an accountant can help you. So I always like to sort of cover that off in any presentation that I do, because I think it's really important to know how to work with all of the professional services firms that you engage with. Ultimately, the best thing to do is always to ask an expert, so it's really important that you have a good relationship with your current accountant and you can ask them all of the questions that you need to ask, specifically with relating to your business and your own finances and how you're performing so far. So that's me, just some pictures of me and the various things I've been up to. So without making this sound like the introduction to some sort of X Factor audition or anything, I did have quite a troubled childhood. My parents generally sort of couldn't really cope with life, so I was raised by my grandparents. But this gave me from quite early on a streak of independence, because I knew that they wouldn't be around forever. So I was raised in a council estate, so I knew that there wouldn't be sort of a property for me to inherit and things like that. So I was quite determined early on to kind of go out into the workplace, didn't go to university. I went into an accountancy office as a junior and literally fell into it, as I think most accountants do. I know very few that wanted to do that from school age, if you know what I mean. Generally, it is something you fall into. But I remember applying for every job in the news shopper, getting offered maybe 3, I think, and one was a recruitment agent. And I thought, well, I don't even know what I want to do for a living, let alone anyone else, so I'm not sure about that one. I think there was one with animals, which I thought was great, but wasn't going to necessarily sort of get me on the property ladder and all of that sort of thing. And then the third was an accounts junior. So I went into an accountancy office right from the bottom, making the tea, doing the scanning, and really worked my way up from there. I was employed by 3 firms before I went out on my own. And the biggest learning was actually from the smallest firm I worked with, because in that firm, you got to see the whole job from beginning to end, whereas the larger the accountancy firm that you're dealing with, the more specialist the departments. So you tend not to have a grasp of the whole picture, whereas in the smaller ones, you're dealing with the job right from a bag of receipts all the way up to the corporate tax kind of thing. It was, interestingly, the last housing crash that caused me to end up going out on my own. So I was sort of happily going along in my employment, got my qualification, etc. I did manage to buy a flat in 2007. I was 23, I think. No, I must have been younger, actually, 20. God knows, I lose count. But yeah, 2007, bought a flat, realised very quickly that I'd been missold a mortgage. I think back then it was 105% self-cert, all of that sort of thing. So quickly realised I had more going out than I had coming in. And that I needed to do something about that, hence starting doing private work. So at the time, I didn't see this as a business. I didn't see it as starting a business. I never had any ambitions of having staff or anything like that. I was just effectively trying to supplement my income by doing some accountancy work on the side for private clients, which was really enjoyable. I liked doing it. You know, I liked meeting business owners, talking about how they made money, trying to sort of help them on a consultancy basis, as well as what tax they've got to pay at the end of the year kind of thing. And I went along like that with the business and the employment side by side for probably about 3 years before I realised that this is a business, I really have something here. And it was actually through a networking event where I met a business coach. That's what sort of made me start to realise. She asked about my biggest challenge, and I think at the time it was that I'd hit the VAT threshold, and I was thinking, how am I going to implement this increase on all these sort of smaller clients that I have? And she helped me write a really positive letter to those clients to say, you know, this is a positive thing because of you, we've grown. This is, you know, a HMRC levy, effectively not a price increase. She also encouraged me to get an office because I had clients' records in my wardrobe, in my boot, and all this sort of thing, which obviously wasn't the best way. And then I was able to sort of start charging more, obviously, because it was more of a premium service. We had meeting room and things like that. And again, sort of left employment very quickly after that, started to grow the business in earnest. Obviously, you needed to compensate for making that jump. And it wasn't until, I think it was 6 years ago now, that I did my first acquisition. And that came about quite by chance. Again, I wasn't looking to acquire businesses, but through my network, somebody told me that there was someone who knew her uncle who was looking to sell his accountancy practice. I think he tried to sell twice to some larger corporates, and that hadn't worked out for whatever reason. He didn't like their ethics. He didn't feel that they would look after the staff the way he wanted. But it was quite clear that it wasn't about money, which is coming back to our sort of structuring a deal conversation. The guy had made his money in his life. He had lump sums. He had 2 properties. He wasn't interested necessarily in a big lump sum. What he wanted was security of an income for as long as he lived. He wanted to know that his clients were looked after, his staff were looked after, all of that sort of thing. So it was those conversations that we were having initially more than what we were going to pay for the deal. It was more about what my pricing structure is. You know, would we be able to deliver the service in the way he'd been delivering it for his clients? Because a lot of them had become his friends, and you know, he wanted to make sure that that was going to continue. So that's how the long earn-out came about, because he basically asked me, there was a freehold property included in the deal as well, and he basically said, do you mind if I ask, are you going to have to borrow the money to do the deal? At which point I said, yes, I don't have that, you know, that amount available to me. And he said, well, I would rather you borrowed that money off me. So if you're going to have to pay it off in time, I'd rather you borrowed it from me. You can pay a very small down payment. I think it was 50,000 against a 550,000 deal or something, and then the rest is split monthly over 20 years. So that's what's happening. We're 6 years into that now, still chipping away. What was good for him is that he was able to retain a charge over the freehold property to kind of secure that, but it wasn't enough to cover what he was owed, because obviously the business made up a substantial part of that deferred consideration. So I think it's only about now, really, that his deal is probably safer, because I think we've got it to the point now where I owe pretty much what the buildings were, so he wouldn't be out of pocket if anything went wrong. But yeah, my solicitors at the time couldn't understand it at all. Well, why would he want jam later if he could have it now, kind of thing? And I said, well, that's fine, but you don't tell him that. I mean, that's up to him and his lawyers to advise him on that front. And since then, as I say, we've done 4 more acquisitions of accountancy. I've also been involved in a mobile beauty company, an IT company. Both of those I sold out of prior to COVID, thank goodness, because the beauty company especially would have been quite significantly affected by that. But yeah, it was definitely a learning curve. One of those deals was not a pretty one, that's for sure. The person I bought the practice from had inflated the client list, so he'd effectively gone through every line and said that each client was paying about £400 more than they were, and the son was taking clients. As soon as I took over the business, the son had previously run the business and gone off probably 6 months prior, gone rogue, and he was stealing the clients one by one. So we lost about 80,000 revenue, I think, in the first 3 months. So yeah, it was definitely a challenge when I ended up selling that on in order to pay what was owed on the deferred considerations. Of course, we challenged it. We went through all the warranties. So for those of you who haven't come across that before, warranties are there for this exact scenario. If the business is not what you say it is, then this is what's going to happen effectively. But obviously all of that takes time, and in the meantime, if you've got a loss-making business that you're trying to sort of plug holes, the staff members have been there a very long time, so it would have been very costly to have cut heads in any short period of time. So yeah, there's a bit of battle about that, but I always find it's the ones that necessarily don't go so well that you learn more from, and the ones that go well, it's like, oh, that was okay kind of thing. So yeah. This is my team, or some of my team now, so we're about 32 of us, I think, over 5 offices, so we're doing some charity walk there. A lot of what I do is going out and speaking to people, offering the business consultancy rather than your sort of day-to-day compliance, which I really enjoy. That's me with a certain dragon. I just like to put that up there, you know, he's not my friend or anything, I just met him at a charity do. And then that was me at an awards ceremony in 2019, so I got Kent Women in Business 2019, which was really nice. Since then I've got top 50 women in finance as well, which is a global one, so I was really, really proud to do that, because it is predominantly a male industry, so it's nice to start to have the women sort of recognised as well as running their own practices. My eventual aim is to make it into the top 100, so that would mean being about double the size I am now, so not completely unachievable, but if I do so, I'll be the first female director to achieve that. Certainly the first sole partner as well, because predominantly large accountancy practices are run by multiple partners, whereas sort of following along more from Jonathan's strategies, I take more of an ownership role, which means I am the sole director, but there are practice managers who handle all of the sort of day-to-day compliance and accounts work, which frees me up really on the strategy and future acquisition plan. So that's a bit about me. We'll start with the more technical stuff, so understanding the accountancy jargon. First term, I'm sure most of you will have heard this, turnover. Everyone familiar with that? So that is purely the sales. This is the sort of stuff that often people get tripped up on Dragon's Den, isn't it? They want to know all of these kind of answers, so it's good to know it. So turnover is your sales. No expenses, nothing like that, just purely what income the business is bringing in. That is net of VAT as well. So if you are a VAT registered business, it's before VAT, not after. The VAT, you're just a glorified tax collector. You're just passing that on. So it's the net that you're looking for. Gross profit. So your gross profit is what's left after the direct cost of sales. So direct cost of sales are things that are directly attributable to your income. So things that would vary based on the number of sales you were making. So that might be, an easy example is kind of manufacturing. That would be your material cost. So if you're making t-shirts, it would be the cotton. That it would definitely be a direct cost. There would be other factors as well. So there might be an element of direct labour if there are wages for a service industry business, for example, mine. You know, I'm selling services effectively, so there'd be an element of gross wages in my direct costs. But it will be different in every industry, so you just sort of have to have a think about what your own direct costs are. And as I say, typically these are variable, and one thing that we look to do is to monitor the gross profit margin. So is that percentage roughly staying the same as you're going along? And that makes sure that you're keeping up with any price increases. Obviously really relevant at the moment if your suppliers are implementing price increases, you need to make sure that to retain your gross profit margin, you're adding that onto your turnover, and then you're making the same percentage every time you make a sale. Net profit, that is right down at your bottom line on a profit and loss account, and that's what's left after everything. So not just your cost of sales, but also your overheads. So if you've got rent on a premise, if you have accountancy fees, if you have admin team wages, all of that sort of thing would come into it, and net profit is what you're actually left with. So that's a really, really key figure. You've probably heard the phrase, turnover's vanity, profit's sanity. That's the reason. That's what's actually ending up in your pocket. So you can imagine that that's quite a significant figure when it comes to business valuations. Buying a business, you want to know how long your return on investment is going to be. So if you've paid X amount for a business, well, how many years of net profit is it going to take for you to have that money back in your pocket? And that's why we talk about sort of multiples of net profit, for example. You've probably heard that said. Profit and loss account. So that is simply just a document which gives you all of the top three. So you should have on there your turnover, your direct costs, your gross profit, all of your overheads, and then your net profit at the bottom. If you're a limited company, it would be submitted at Companies House and HMRC every year. If you're a sole trade or a partnership, then it would just be HMRC on the tax return, but it's the physical statement. We at Bells recommend that everybody should have sight of their profit and loss account really at least once a month. I explain it as it's like flying a plane without a navigation system. If you don't have a grasp of those numbers as you're going along and you're just literally looking at it once a year in hindsight and saying, oh, how did we do? Then to me, it's more luck than judgment. You know, you need to be seeing it on a regular basis so that you can compare. You can see trends. Are we going up? Are we going down? What are we doing this month, this year as compared to this month last year? You know, is the business going in the right direction? So there's a few sort of key performance indicators that we as accountants would recommend you keeping an eye on, really, because lots of business owners, there's only sort of what they've got in the bank, which isn't really enough if you don't know what you owe and what you're owed and all of that sort of stuff. So good thing to be grasp of. Balance sheet. So balance sheet is a bit more confusing than profit and loss, some people find. Balance sheet is a snapshot in time. So where a profit and loss is the totals between this period and this period. So it might be a month, it might be a quarter, it might be a whole year, but it's going to tell you how much income and how much expenses has gone through the business in this period of time. The balance sheet is just a snapshot. So as at that date, as at the date you're preparing the balance sheet, which for most people is their financial year end, what did the business look like then? And it will include all the business assets and liabilities. So it will be things like your bank balance, how much money is in the bank on that day, how much do your customers owe you? How much do you owe to suppliers? How much is owed to the taxman? How much is owed to you as a director? So it's all those kind of key figures that any business really should know, but it would only be a set period. You know, you can only ever measure it on a certain day, basically, and usually that corresponds with your financial year end. Debtors. So debtors is the amount your customers owe you. So If you're a cash business, obviously you may not have any debtors, your customers might pay up front or they might pay there and then, you know, retail, things like that. But for lots of businesses, they issue an invoice and then wait to get paid. And that figure is really key. And very, very often when you get an insolvency case or something's gone wrong in a business, there is a problem with debtors. So it could be that no one is chasing those debtors. So some businesses get into the mentality of once the job is done and the invoice is issued, it's finished. There's nothing more to do. And actually the job is finished when you've been physically paid. So it's really important that you have strict processes in place for debtors, that you have automated statements that go out. You have someone who telephones those clients at the point that invoice is becoming due or indeed overdue. And also it forms part of those KPIs that we spoke about. So you need to know how much you're owed. And if that figure's rising, it could be something to do with the credit control procedures, really. And don't forget as well, all of these things we're talking about, this also is true when you're looking at a business's account. So that's part of what I want to give you today, is not just to analyse your own business, but if you're contemplating buying a business, these are all the sorts of things that you'd be looking at. So in the last 3 years, are these debtors climbing? You know, are they owed more and more money? Is that an indication that maybe their customers are in trouble or, you know, not as financially viable as they were? So that's debtors. Creditors, the opposite. So that's what the business owes to their suppliers. So it's all very well saying the business has got 100 grand in the bank. If they owe their suppliers 300 grand, then that figure in isolation is not enough. So you need to know both things in order to look at the financial health of the company. And I think, again, that's a lot of the time where business owners might be a bit blinded. So they might know that, yes, I've got this amount of money in the bank, but it could also affect how risk adverse they are, because if you don't have these numbers, you might not know if you've got enough. You might never know if you've got enough, you know, because you don't know what's coming up. So you don't know how much of that money is surplus, how much you need to save for tax, how much you've got coming up for wages at the end of the month. So again, really, really important figure, what the business owes as a whole. Stock. So stock is what the business holds in inventory. So effectively, if you've got a shop, they buy stock for that shop. So say it's an off license, they buy lots and lots of crates of wine. The accounts will show you how much that stock is worth. And when we say worth, the standard valuation for stock in a set of accounts is the lower of cost or net realisable value. So it'll either be what the company bought it for, or if it's been adjusted, it will be what they can get for it, because that might be less. You know, there are certain items that are obviously perishable, they go down in value over time, they might not be able to be sold for whatever reason at the price that they were purchased for. So that's the standard valuation. Normally, in the context of trying to buy a business, what you would look for is a specific stock list, so you know exactly what they have got and what that stock is worth. You wouldn't just take the figure from the set of accounts, because again, that would just be potentially what they bought it for. You know, if they haven't done adjustments and all of that sort of thing, it might not be an actual. So it's really important to get the actuals, and then you can work out what the market value is. That's what that stock is worth to you. Work in progress. So this is kind of the service industry's equivalent of stock. So if the business doesn't have stock, for example, my business is an accountant, we don't actually hold goods, but we do have work that's in progress that hasn't been billed. And say a business, somebody bought my business at the end of this month, there might be, say, £100,000 worth of work that we've done. It's in various stages of completion, but it's not yet been invoiced. So again, it's another potential benefit for a buyer, or it's an important factor, one way or the other, to consider it when you're looking at structuring a deal. And it could be that the previous owner might ask you to make an allowance for work in progress. They might ask you to sort of add that on if they want to be paid for, you know, they've paid the staff to carry out that work. They might want you to adjust your offer to meet that, but that's effectively what it means. Obviously, whether you did that or not would be down to yourself. Depreciation, amortisation. Anyone heard of this one? Yeah, everyone's familiar, great. So this is just a book entry, basically. This is not cash, this is not money that you've spent, but in your accounts, because when you buy an asset, that goes on the balance sheet. So be it a van, a piece of equipment, that gets added to the balance sheet. It's not a profit and loss item. It's not something that's written off. It's not something you're looking to sell. You buy it and it's kept. So it's put on the balance sheet as an asset. But it can't stay there for all of time at that value, because it's going down in value. So what we have to do as accountants is decide upon a rate of depreciation or amortisation. Depreciation is when it's a physical asset, so they call it a tangible asset, so that would be something you can touch, a car, a vehicle, a piece of equipment. Amortisation is when it's goodwill, so when you've bought the goodwill in a business, that would be similar to accountancy, so there's very little actual assets. You know, I might have in a deal included maybe 6 to 10 grand of computer equipment, second-hand computer equipment, not worth a lot of money. The bulk of what I'm paying for is goodwill. It's the relationship that that business has with those clients, effectively a list of names and addresses. The way we depreciate that is via amortisation. So it's just two different phrases to reflect whether it's a physical object or whether it's a more of an intangible sort of goodwill item. And as I say, we adjust for that each year. It goes through the P&L. So it's worth, when you look at a set of accounts, you want to, if there's those figures in there, you should be mindful that that is not an expense of the business in the sense of it's not some, you know, money that's been spent. Doesn't affect the cash that the business is generating. It's a book entry. So, purchasing a company, purchasing goodwill and assets. Obviously, we touched upon goodwill and assets with regards to depreciation. These are the two main methods for buying a business, which I'm sure you will have covered previously with Jonathan, so I won't go into too much detail apart from the accountancy implications of this. So, when you purchase a company, what you're effectively doing is you're purchasing the shares of the person that currently owns that company, and then the company becomes yours. So you have to think of it, the company is a separate legal entity to you or the owner that's got it at the moment. You're transferring ownership of that company between you. That, to some extent, carries more risk because you become responsible for that company and all that's gone before you. So you can't just say, well, none of that's my issue, what happened before. You are effectively responsible for the company from that date forward. So if, for example, the HMRC raised an inquiry into that company's accounts and found unpaid VAT, that would be down to the company. It's not down to you, but you're the person that's ultimately got to deal with it, and it's your money as a shareholder that it's coming out of. So that would be the reason why there would be probably significantly more warranties in your asset purchase agreement when it comes to buying a company than it does buying a goodwill, because you're taking kind of an unknown risk, if you know what I mean. You don't know what dodgy dealings that company might have been up to in the past, and you need to make sure that you're protected from all of that, because you are going to be the new director of the company, and any of those issues that arise, you are going to have to deal with. When it comes to purchasing goodwill and assets, that's somewhat simpler in that you're just literally purchasing whatever the company owns. So whether that is goodwill, whether that is physical equipment, machinery, vehicles, that kind of thing, it's those two things together. You would buy those from the company. So you're not taking the company forward, that's left with the previous owner. There are various reasons you might do that. One might be risk, which is obviously what we've discussed before. Two might be that there are other things going on in the company so that you don't want, so you might just want a part of it. Therefore, you'd buy it from the company. From a tax perspective, if you've purchased goodwill and assets from a company, the payment you make belongs to the company, not the individual. So again, when you're talking to business owners about which of these you're going to go for, you have to be mindful that if you buy goodwill and assets, if they want to get their hands on that money personally, they then have to get it out of the company somehow. So that might be via future dividends. That might be via what we call a members' voluntary liquidation. So they can subsequently to selling off all the goodwill and assets, wind up the company and still obtain what they call entrepreneur relief. So entrepreneur relief is what happens when you purchase a company in its entirety, provided the previous owner is eligible for entrepreneur relief, and there's a whole host of conditions that we won't go into today, they should be able to get the proceeds of that sale for a net rate of 10% tax. So that's why for a lot of business owners that option might be more attractive. But there are ways to purchase goodwill and assets and still benefit from that entrepreneur relief by potentially winding the company up at a later date and distributing the funds that way. So these are all sorts of things that you should be talking to your accountant about, who can help you to reassure a previous owner of the tax implications for them. Obviously, they'd have to seek their own advice anyway. Your accountant wouldn't be able to advise them. But if you are getting objections on that basis, oh, it's not as tax efficient for me to do it like that, they probably need a different tax advisor that could let them know all of the ways that they can make sure it's tax efficient on either event, really. So, yeah, that's the sort of main differences. Does anyone have any questions specifically on anything that we've covered so far? Yeah?
Right,
let's get, we need to use the microphone so that everyone at home can hear. So where's our mic? Oh, you have it already. Go for it.
Sorry, I'm jumping in ahead of people then. Can I take you back to the amortization? I'm not an accountant, I don't understand it, but I understood it was more than just applied to goodwill. I thought you can amortize something like a laptop that has only a shelf life of, say, 5 years because of technology changes, that you can actually write off 1/5 of it each year for 5 years, and that's called amortizing it over a period. It's a fixed rate rather than a sliding depreciation rate. Is that correct, or have I got it wrong?
No, so depreciation can either be fixed or sliding. That can be either. The difference is whether the asset is tangible or intangible. So that, for a laptop, it would still be depreciation.
Okay, thanks.
I always like to stop for questions at this point because otherwise it's just too much to me keep waffling on all the time.
I was just going to ask a question about purchasing goodwill and assets. If we're using holding companies, can we put it into an SVP, a special purpose vehicle, and then can we move all the IP and any other tooling or other stuff into the holding company so straight away, or is there sort of rules around how we do that?
No, absolutely. So your SPV can purchase the goodwill and assets of another company. That's absolutely fine. Yeah, it doesn't have to be you personally that buys it. Yeah.
And you can then move it up into your holding company, the IP straight away, or do you have to wait?
No, you can't. I mean, there are complications to that and potential tax implications. You'd have to evidence that it is in effect a group of companies and meet the group of companies conditions, but it is possible.
Okay.
We just come to heads of terms with, and we're going to do a share purchase. And one of the current owners we're keeping on as a director so that we can keep going with suppliers, the lease, all the rest of it. So he will no longer own the business. Will he still be eligible for entrepreneurs relief?
So is he a shareholder at the moment, but he's giving up his shares?
Yeah, he's giving up the shares.
So theoretically, for him to obtain entrepreneur relief, he can't work in that same industry as a self-employed person. He might be. I wouldn't be able to give you complete clarity on that without knowing his own tax affairs, but that would complicate it slightly, that he's staying on, definitely.
Hi, Joe. After the 1 million for entrepreneurs relief, if we're giving them initial consideration of, say, 2 million, so 1 million's cash and the other one is going to be the sale of a property, how do you calculate the tax on the 2 million from the property? Is there anything that we can do to make that more tax efficient? How's that calculated?
So are you the seller or the buyer in this example?
Oh, buyer.
You're the buyer.
Yeah,
okay,
but we're considering the end result for him. So I have been asked this before.
Certainly. So for him, it depends how he goes about accessing that money. So potentially, if it's left in the company, that's one alternative. There is a thing called business asset disposal relief, which you can use for property. So that might be a sort of a useful condition to look at. Or he could take dividends over time. There's kind of lots of different factors, but what I would advise is to advise him to go and see a tax advisor prior to finalising the heads of terms, so that he can make sure it's structured in a way that it is as most tax efficient as possible for him.
Thank you.
No problem.
So, just touching on what Felicia says, so that entrepreneurs relief, you get 1 million in your lifetime, right? So you get 10%. So say that the seller sells a business for the 2 million. So they'll get 10% on the first million. They don't get that relief on the land and buildings as well. So I think what Felicia was asking was, what percentage would they pay on the second million? Would it be 20% or would it be more?
It would depend on a number of factors. Yeah, it would be. Yeah, you'd have to work out based on the current structure of the business, how the properties are held. Is it within a separate business?
Yep.
There'd be a lot of factors to that. Yeah, I always hesitate to answer specific questions in case there's factors I haven't seen, but more than willing to look at it for you after if that would help. With the specifics. Happy to give you a certain answer on that.
Yeah, you see, I pulled out of a deal a couple of weeks ago, and it was a sole trader and it was an asset purchase. So the deal was £1 million, and the way the business broker had sold it to us was 923,000 was the asset value, 77k was goodwill. So we were all right with that. We did the cash flow forecast for the 5 years. So we were able to reduce the balance of the assets over 5 years, which meant that we didn't pay tax to the 5th year. But then he wanted to change the goodwill and the asset values, which he pays 10% in the goodwill value, but it ended up pushing 25% corporation tax onto us, and it would bring that corporation tax in at year 2 or year 3, depending, obviously, the asset value and the goodwill. So.
And I think that is one of the issues with all of this stuff, is that sometimes what's best for the buyer isn't best for the seller, and vice versa. So it's almost like two tax advisors potentially battling it out to get the best.
Well, as I say, we've been in negotiations for 6 months and 3 weeks to completion. He speaks to his accountant, who tells him he's liable for a 46% balance and charge on the assets. Hence the reason why he was scrambling, trying to make us pay more for goodwill and less for the assets, because it saved him a lot of money, as I says. But it could have been sorted out if he got an accountant in at the beginning. So I think the lesson I've learned from it is we don't negotiate with vendors or business brokers. Accountants will deal with accountants, lawyers deal with the lawyers, and that's the way it works. Know what I mean? Otherwise, you could be 15, 16. Ended up costing us about 18 grand to pull out of that deal. You know, whereas if he'd told us 6 months before, we could have done something, he could have incorporated it into a limited company, we could have done something where he would have walked away with more money anyway.
And the great thing that you as a buyer, now you know that, you will make sure in the next deal that you'll make sure that the accountants are talking before you even start talking about that side of things, isn't it? Because, it's difficult. And quite often, you might have bought a business before, they've never sold one. So they're not necessarily aware of all of these things, or they haven't asked their accountant the questions. And, there are some really, really clever tax specialist accountants in this field that we employ, but there are others, all over the place that can work all of this stuff out. It's a good learning.
It certainly is.
You take one more for me.
Just in terms of working out the EBITDA. So generally, I just do the operating profit plus the depreciation. The depreciation figure I'm looking at is effectively what is the bottom right of all the numbers on the balance sheet. Is that right?
So we're going to cover that off in a bit.
Okay.
We're going to do an exercise to actually work out what the EBITDA is, so that you feel more equipped to handle that going forward. So I'll hold on that one. Right, so how to value a business. I'm sure you will have had extensive conversations around this in your group anyway, but effectively what I would say is that it varies hugely based on what someone is willing to pay, but there are guidelines. So even as an accountant, there is no absolute set formula for this is how you value it, and that's the figure. And that's, I think, what throws a lot of people, because people want that figure. They want to know, I'm not overpaying, so you tell me what it's worth. And the issue is, it's worth what someone's prepared to pay at the end of the day. In accountancy, there is a very trade-specific way to work it out. So we value our assets or our clients at a multiple of what we call GRF, so gross recurring fees. So we're not interested in EBITDA or net profit or anything like that, because if you imagine my business already has PI insurance, it already has labour costs, it already has a premises, it already has a practice licence, all of that sort of thing. I don't need to incur all of those things. So I'm not really concerned with what the current owner is paying out for those things. I'm only interested in how much clients they have and how much those clients are paying on a regular basis, because I'm going to bolt that into my existing business and ideally increase my profit margin. There are other businesses that also have those standard industry valuations. So you have to look into that, particularly if it is a business that you are not in yourself or you're not as familiar with, because there may well be sort of industry standards that apply, and the owners may or may not be aware of those guidelines. Multiple of GRR, so gross recurring revenue, could be revenue or fees, depending in accountancy's fees, but there are other subscription-based businesses, for example, gym memberships, IT support, all of that sort of thing. They all have gross recurring revenue and will sometimes be paid as a multiple of that. Multiple of EBITDA, this gentleman mentioned that earlier. So EBITDA is earnings before interest, taxation, depreciation and amortisation. There's a sort of little formula there. So the reason that's a significant figure is what we're trying to get to here is the cash. How much cash is this business actually generating? So your net profit, as we discussed when we went over depreciation and amortisation, is not a reflection of how much cash that business is generating, because there'll be adjustments for non-cash items such as depreciation. No one has physically paid depreciation. So in order to work out how much cash it's generated, we need to add that back. We need to add that back onto the bottom line. Similar with interest. So interest is not part of the operations of that business. That's to do with the borrowing that's specific to that business. So you as the new owner may not have that borrowing, or you might have more borrowing, but it's not relevant to how much cash is being generated. The cash is going to pay that interest, and obviously if you are taking on a business that has debt, it's a significant figure. You need to be aware of, you know, what the covenants are of that debt, is there enough coverage, all of that kind of thing. But ultimately, it's not telling you how much that business is generating from an operational perspective. And taxes, of course, taxes, they're dependent on how much profit you've made, so you don't want to look at how much tax that business paid in that year. That will be down to you when you take it forward, how much tax you're going to pay and what your own rate of tax is indeed. So that's why we take the bottom line figure and we add all of those things back in order to come to an EBITDA. Plus assets or minus liability. So this is only relevant if you're buying the company, not goodwill. So if you're buying goodwill, obviously you know what you're buying. It's these assets and it's this goodwill. If you're buying a company, obviously you take over all its assets and liabilities, so you need to add those or take those away depending on whatever multiples you're coming out with, because you might well get a really good figure, you know, £1 million or whatever on a multiple of EBITDA, but actually this company's got £900,000 worth of debt and you're going to take that debt on. So you need to adjust your calculations for those balance sheet items, basically. Other factors, trends and SWOT analysis. So everyone familiar with SWOT analysis? Strengths, weaknesses, opportunities, threats. So trends, that's about looking backwards over a number of years of accounts. So what we don't want to do is just take the year before. It's not enough, because we need to know what's happening here. Is this business in decline? Is it increasing? That will affect the multiple. You know, even when you have got a set multiple, usually there's a bracket, so it might be between 3 and 5 in terms of a multiple. So is it at the lower end of that scale or is it in the higher? Things like trends will impact that. You know, we need to know what's happening with this business. SWOT analysis, you know, all of that stuff comes into it. If this is an industry that has huge opportunity, is hugely in a growth phase, I've seen people pay 10 times multiples, you know, for businesses, because they know that that's going to fly, or they know that that's going to be a brilliant bolt-on to their product or service, and it's going to bring them loads of new customers that actually are going to buy their existing product and service as well. So, you know, there's more to it. There's potential, is what I'm trying to say. You know, it has different potential depending on the buyer, and all of that stuff is really important. Due diligence is key. So I'm sure you've all heard the term due diligence. It's really, really important in buying a business, and you need a professional to undertake it, I would say. You know, not everyone does, it's not the law, but I would always recommend getting someone who offers this as a service, because they'll have a lot more familiarity with what questions to ask, what to look for, and also there's a liability aspect there. You know, you want to protect yourself. If you've paid someone to do due diligence and they've not found something, well, potentially you would take that up with them. There's a claim factor there, so it's an extra layer of protection for you, apart from what your solicitor will draw up in your asset purchase agreement with regards to warranties. There's also, it will lift things that you need to ask questions about. So even if something comes out of the due diligence, oh, there's something here that we weren't aware of, it doesn't mean the deal's off the table, it just means you need to ask about that specific thing because there's some anomaly there, something that is unexpected. So these are sort of things that we would recommend asking for as a minimum. And obviously if you work with a professional that is doing the due diligence for you, they will give you a list of all the things they want you to ask for. And again, I caveat this with this may well vary depending on the industry, depending on the legal status of the business, all of that sort of thing. But in most general terms I can manage, it's 3 years of financial statements, so that would include your profit and loss and your balance sheet. The VAT returns, if the business is VAT registered, a really good starting point is to compare what was declared on the VAT returns with what went in on the financial statements and see if there's any anomaly there, if they match up. It's important to note that most financial statements are produced on an accruals basis, which means based on how much the business has invoiced in that time, not how much they physically received in cash. And sometimes VAT returns are done on a cash basis, depending on the size of the business, if it's below the threshold. So again, that's something, these differences don't necessarily mean a red flag, it's just a question to ask, effectively. Bank statements. Have a look at the bank statements. Bank statements tell you a lot that the financial statements won't. Are there loads of bounced direct debits going on? Is there loads of money being sucked out by the owners? You know, you can tell a lot about the health of a business by looking at the bank statements and the types of things that are going in and out. You know, is there a payment plan with HMRC, for example? You might see direct debits and all sorts going out. So that's a good starting point also. Payroll records, really, really significant if you are taking a business that has employees. So lots of you who've bought businesses before will be familiar with 2P, transfer of undertakings for the protection of the employees. It's all to do with HR and employment law, making sure that those individuals continue to have the same benefits they had in the previous company, make sure they have the same salary, that their years of service is recognised. So obviously you can imagine the payroll records will give you a lot about what kind of risk that is, what that looks like in terms of 2P. If all those employees have been there 20 years, then you should know that that's going to cost you a lot of money in redundancy potentially if you need to downsize those employees for whatever reason because the business is not what you thought it was. It'll also give you the facts. So a lot of the time when business owners are talking about their staff, oh yeah, he's on 20 grand, he's on 30, and then when you actually look at the payroll, it's like, well, hang on a minute, his P40 or his P60 says this, and it's like, oh yeah, I'll give him a bonus once a year of this amount, and it's like, okay, well that comes into it, you know, obviously, if he's used to that, and if that's been a consistent thing that he's been receiving, then you're going to have to do that same thing. So it's really important to look at the payroll details. Also, if there are any other things being paid for, you know, car benefits, health insurance, all of that, you're going to have to maintain that or fear the wrath of an employment tribunal. So really important. Stock list if applicable. So we touched on this earlier. Stock list, what it says for stock in the company. Some companies, or certainly larger companies, some smaller companies do have take an actual stock list at the year end, and obviously that's great. Lots of them don't. Lots of them do an estimate and go, okay, well, last year's stock was approximately this. Our turnover went up by 20%. Let's just say our stock's also gone up. And it's bad because the stock is really significant to the profit. So if you imagine what you've got left in stock really impacts how much profit you've made, because without that stock adjustment, the profit and loss assumes that you've sold everything you purchased. And that's the profit. So the stock lets you know what those variables are. So you want to see actually what actually have they got and what's it worth. Fixed asset register. So a lot of the time on a set of financial statements on a balance sheet, you'll just see there's a total figure for motor vehicles, total figure for plant and machinery, fixed assets. You want to know what that is. Is it computer equipment? You know, how old is it? When did they buy it? You know, what condition it's in. You want to see the actual register. What actually is it that you're getting? Because this is often where people fall down between what they think they see on a set of accounts and what they think they're buying, and then the reality of that is something different. So this is why we ask for these things at the due diligence phase. And incidentally, we would recommend doing a due diligence really quite early on in the process, because again, you don't want to waste loads of time. If it's not what you think it is, then let's find that out earlier rather than literally just before we're about to sign the APA kind of thing. List of debtors and creditors, again, you'll have lump sums in the financial statements. It won't really tell you a lot. It won't tell you from a creditor's perspective how soon those things are due. So you might have loans over a year, 24 months, 5 years, 6 years potentially. So you need to understand in quite a lot of detail what the creditors looks like, who does that business owe money to, and how old is that debt. And similarly on a customer basis, you know, you might the debtors figure will significantly inflate the balance sheet. So if they're saying, well, we're owed 200,000 from our customers, that's classed as an asset on the balance sheet. It's increasing the value. But if when you look at that detailed debtors list, actually 50% of that is more than 3 years old, or, you know, a year old even, you might go, that's not collectible. It's not collectible debt. You just haven't bothered to write off your bad debt. And what you would normally do is write it off through the profit and loss. But if it's just sitting there forever and a day, then, you know, that's not money that you're ultimately going to be able to collect. So you want to know how much of what customer debt they have got, how much of it is significantly overdue. I've even had ones where there's debt still on there for companies that have been dissolved, officially dissolved on Companies House. So it would be impossible to collect it. So again, really, really important to know who those companies are. Things to remember when structuring a deal. Everything's negotiable. So yeah, absolutely everything is negotiable. There are no set rules. There is nothing that says you have to pay this multiple, you have to do this, you have to do that. Everything can be negotiable, and you can, give with one hand, take with another, that kind of thing. Listen more than you speak. So that's a top tip that I learned, really, that it's about listening to what the business owner wants, not what you want, if you know what I mean. Because they're ultimately going to be the ones that are going to decide to sell to you at what price. So it's really important that you understand what their values are, what are they actually looking to get out of the deal, and even things like down payments. Lots of people talk about those. Again, there's no set percentage that you have to put down at the beginning, but they might have a set figure in mind. So one of the deals I did, the guy was building this house in Mauritius. That's where he was going to retire to, and he needed 100 grand to finish this house. That's what he needed. And so long as he got that, he didn't really care how long the rest of it took or what the outcome was. So just having that conversation, what's important to you, quite often it might be better than what you think in terms of a deal from your perspective. So yeah, really, really ask a lot of questions and listen out for those cues that suggest it might not be about the money as well, that there are things that are more important, that you'll guarantee, those staff members for X period of time, or the customers will be looked after the manner they're expected, etc. Low down payment, obviously that's what we're all aiming for, but the reason for that, and it's important to understand why, is because that's the risky bit. That's the bit, the money you're putting down before you've actually got your hands on the business. That's the thing that's really difficult to recover. You can negotiate and adjust a deferred consideration payment because the business has not performed how you expected, or something wasn't right with the asset purchase agreement. But what you've already paid, you're effectively going to have to go to litigation to recover that. So that's why we want to keep that as low as possible, because it reduces the risk factor effectively. As long as possible for deferred consideration, obviously, we want as long as possible, and that is again to potentially uncover more issues and also to reduce the financial risk. It is big chunks of money that are going out in deferred consideration potentially, so you don't want to put yourself under more pressure unless you're really confident in the cash flow forecasting that you've done. You're going to have that money and the business is going to pay for itself. You definitely want to put a bit of a contingency in there for what happens if 20% of the customers do leave, or all of these other things that you will have identified when you did the SWOT analysis. What if any of those happen? You need to be prepared for that. Use money in the company bank account if possible. That's something I'm sure Jonathan will have covered off with you. But again, it goes back to the conversation we were having earlier about the limited company specifically being separate to the owner. The money that sits in that company bank account does not belong to the owner at this point in time. They have to get it out. So if they have to take it out, then they might not have any real sort of tax efficient way to do that, because the likelihood is they'll be looking to take it as dividends, for example, which will be subject right into higher rates of tax, potentially 50, 60% of tax, depending on what other earnings that they have. So they might well consider a deal where that money forms part of it, provided it means they can take advantage of the entrepreneur relief or whatever other way they're thinking to structure a deal. So definitely worth exploring that as an option. And use Jonathan's methods to ensure you have nothing to lose. So to tell you a bit of a story, when I first met Jonathan, I realised that most of what I had done was completely wrong. I heard him speak about his structures and his strategies, and the way I bought a lot of the businesses in the early days was I did borrow significant amounts of money. I did give personal guarantees. I did put high down payments down if needed. I never considered the option to use the business as leverage and all of that sort of thing. So that's obviously impacted on the advice that I give going forward, and indeed the way I would go about doing it. But I definitely think it helps when you have that track record. Once you've done one or even two, I see the sellers visibly relax in the sense of, oh, you know what you're doing. And then they just want you to tell them how the process works, or, how you need it to be, rather than them feeling like they need to call the shots, even down to the finite detail of when are we going to tell the customers? When do we tell the staff? How do we tell the staff? What does that process look like? The more knowledge you have around that, the more reassuring that is for sellers to think, yeah, this person knows what they're doing. So, what things can accountants help you with? Tax advice for buyers and or sellers. Creating and maintaining dashboards of KPIs. So that can be for existing businesses, businesses you're looking to purchase. Management accounts to assist any lender investor with affordability criteria and keeping you on track. So again, really important to have up-to-date information, especially if you're considering lending. They're going to ask for that, and then they're going to want it going forward because they're going to want to monitor the performance. Cash flow forecast to establish gaps in funding or whether lending is affordable for this particular business. So again, cash flow forecasting really important. It's totally different to profit and loss. What actual cash are you getting in? When are the tax liabilities due? All of that sort of thing. Where there might not be enough in the bank account to cover it, and what we're going to do about it. Business and marketing plans to ensure you have a watertight strategy. So obviously you've got to do all of these things once you've taken over the business. What are you going to do with it? Introductions to businesses who may be looking to sell or recommended providers. If any of you haven't already spoken to your accountant, please go and do so. Let them know that you're on the hunt for businesses in XYZ industry. I mean, we are a relatively small practice in the big scheme of things, but we deal with 2,000 businesses across Kent, Surrey and London. That's our client base. So there's no one we won't have connections with if it's, someone in the food business or retail, whatever it is you're looking for. So your accountant could be a really good source of those leads. They'll also know who's potentially older, who might be thinking about retiring. Those clients will start to talk to their accountant about their exit strategy. What does that look like? Oh, if I did sell it, how much money would I be left with? What tax would I pay? That kind of thing. So definitely have a chat with them about that. Valuations and due diligence. So obviously that's the mechanism of purchasing. You want to make sure you've had a professional look over those figures. Strategy, planning consultation. So again, if you're looking to implement a strategy that involves acquisition and rapid growth, there will absolutely be tax implications to that. The gentleman here mentioned SPVs, all of those things really, really great to know and understand, firstly to mitigate risk, but also to minimise tax. Thank you for listening. We are going to do an exercise, or a couple of exercises actually, to go through a few actual real sets of accounts to kind of help you know how to get to the grips of these numbers. But that's the end of the kind of me giving you information section.
So what we'll do, we'll have a quick 10-minute coffee break.
Good
but
idea.
before you go, I've got a little bit interested in the fencing industry. So, standing over at the back there, I discovered that if I Googled fencing contractors mailing list, I actually came up with fencing contractors mailing list. It's a bit of an older site, but it's MTW Research Limited in Cheltenham seems to have an extensive mailing list of fencing contractors. Then I found on the Checkatrade. So Checkatrade lists fencing contractors. So I'd go to Fiverr.com and I'd be getting someone to go through that list, do what they need to do, scrape it, stick it into an Excel spreadsheet. And then I found on insightdata.co.uk the main contractors database. There's all sorts it has a construction file that is then segmented. They've got 4,833 contacts. And then I found, see, you get into it and you start sort of getting interested, don't you? The name of the last one? It's just insightdata.co.uk. All I did to find this was just Google fencing contractors association, database, mailing list. I found the UK Fencing Industry Awards. Sounds like a fun night out. Looking forward to that one. And also the Landscaping and Fencing News website as well. And another one of those sites, I can't remember which one it was, also has a members list, has all their members. And again, you just go Fiverr.com, looking for someone to scrape this, put it into an Excel spreadsheet. If you listed that on Fiverr now, you'd have it done before you go to bed.
Sorry, what was the last one? Landscaping?
Oh, I don't know. It was, all I did, it was the, what did I say?
Sorry, news.
Landscaping and Fencing News, yes. The latest news in the world of fencing. Right, okay, so let's take a 10-minute break, please, and then we'll come back and we'll do the exercises. Brilliant. Thank you, guys. All right. Up to you.
Hi everyone. Right, so as discussed before we went to break, as we mentioned before we went to break, we're going to do a couple of exercises now, because I think, you know, all the theory is all good, but the best thing you can do is actually to look at a set of accounts and start to kind of ask these questions for yourself and come up with observations and all of that. And that will be the thing that hopefully gives you a bit more confidence about doing this stuff yourself. If you haven't done it before, some of you I know are very experienced and will have done this before, so that's great, because we've got a mixed group that can guide each other. So the plan for this afternoon is we're going to split into groups of 4, if that's okay. Maybe someone you haven't worked with before, that might be a good idea, just to hear again different perspectives, different industries. We're going to leave, off we go for an hour, and we're going to have 2 exercises. So you might want to spend half an hour on each, or you might want to split your time differently actually, because you might think one is more simple than the other, however you want to do it. And then we're going to come back into the room for 4:30 basically, and we're going to have a feedback discussion and observations, basically what we found. So here we have 2 sets of accounts. So these are 2 different industries. I'm not at this stage going to tell you what industries these are, because I think it's an interesting observation to just look at the numbers and see if you can maybe not have a guess, because it obviously how long's a piece of string, but make some observations based on what you are seeing without making assumptions based on the industry. So there are 2 sets of accounts. There's a balance sheet and a profit and loss. And what I'd like you to do firstly is just to make some observations of what you see. So what sort of things might you ask when it comes to looking at this? So is there something that you think, oh, that's a bit strange, you know, a change between the 2 years? So this has the current year and a comparative. So you might spot something that you think, oh, why is that? And that's all really the process of due diligence is, apart from, you know, checking everything that's on here back to the backup information. It's also about just observing what you're seeing. And the second exercise is to come up with a valuation for each of these businesses, or what you think that they might be worth. I will let you know the industry when you're ready to do the valuation. So if you come and let me know, once you've done your observations, whoever the spokesperson is for your group, if you come and let me know that you're ready to move on to the valuation perspective, then I will let you know what the industry is, because I think at that point, obviously, it's important. You need to know if it's got recurring revenue, etc., etc. So is that all clear? Is everyone quite happy with that? What we're looking to do, and we'll see kind of the variance, what's going on in the room.
This morning it was groups of 2, and that was confusing. So groups of 4, it's going to be absolute chaos. But I back up what Joe said. Go with people that you don't know so much. So you know, it makes it more interesting being with new and different people. Thank you.
Absolutely. So whenever you're ready, if you come and grab a sheet and. Brilliant. So I hope you found that exercise useful. I definitely heard some good discussions going on and good observations. Thank you. So yeah, I hope you found that useful. I definitely heard some really interesting discussions going on. So hopefully you saw that the major objective for me is to show you the variables, show you, all the different points you'll come up with, all the unknowns that come out from just a set of financial statements. Obviously how the sector impacts it. So what did that make you think about the business? Did that make you think differently to when you just saw it as a completely raw balance sheet and P&L, obviously? And hopefully you kind of got into a bit more of a sort of confident run of looking at the accounts, asking questions, the sort of stuff that would come up in due diligence, and maybe on the valuation process as well. So I'll go around the table just to ask for the two main points that you think you come up with, or points of discussion, observations, questions you would ask to a potential seller, and obviously what you came up with for your basis of your valuation, really. And if there's a scale, of course, you can give me the scale, it doesn't have to be an exact figure, and then why you thought that. So it's those 3 points, really. So
Where would you like to start, Joe? Which table?
We start with this table?
Okay, there you go. Take it straight to you. Go on, Charlie.
What did we come up with? Feed me information.
Yeah, you're fine, you're fine. Just go. Talk. No, don't chat.
Come on, come on, ladies first.
Go.
It needs to come on that. For the first one, which was the food wholesale and distribution, we had two different types of method used. The first method was the NBV, the net book valuation, and we just pretty much opened it up, looked at what the assets was, looked at what the liabilities was, and the difference in that, and we just noted that as the net book value. Then we also looked at the EBITDA approach, and that's the one we were a bit, there were different views on this one. One of the view was to take just the multiple of the operating profit or the EBITDA and multiply it by different multiples. Some suggested 2, 3, 4, and no one went beyond 3 or 4 anyway. The third approach or method which was taken with regards to there was to look at the EBITDA and add the net assets onto that. So maybe multiple of 1 EBITDA and add the assets onto that in order to get evaluation. So what became very clear to us is there are different methods of getting evaluation, and you determine what works for you.
Yeah. Absolutely. Yeah, good, really good point.
Thank you. Anyone else?
Any particular questions you would ask that business owner? So was that the IT support one you were looking at?
No, we looked at both of them, and for the IT support one, I think the consensus was just to use a multiple of EBITDA because it was less complex compared to the manufacturer, the wholesale one, and it was just using a multiple to get the calculation. We did have questions about the director's remuneration. It wasn't clear where that was, so we only saw wages and whether the wages was what covered, including the director's payment, whether they were salaried. He opened questions on how they got paid, so were they a direct employee to the company, or was there another method where they may come in as something else, and that wasn't clear to us.
You're right, and usually that would be stated separately, direct remuneration. So that does suggest that maybe that person was not taking a salary to help the business grow or whatever.
From the IT one, we saw there was limited assets or little tangible assets which was expected. We noticed that the creditor had increased for that year, but then also the sales increased, so there may be a correlation there. Well, eventually, this was more of a straightforward multiple of the EBITDA, and it's just having an understanding what the EBITDA for that industry is, and just do your multiplier or whatever the person's motivation is at the time of trying to make the transaction happen.
Absolutely, and
Yeah.
I think we had a conversation with the table over here about creditors as well, and
Yeah.
that can be loans, it can be tax, it can be suppliers
Yeah.
even. So it's important to get clarity on what that is and what the terms are of any debt that is
Yeah.
associated.
Yeah.
Fab. Okay. Anything else?
Just looking at I think the manufacturing, the wholesale one gave us more, of a riddle to work with. Let me see. Yeah, I think that's pretty much it.
Perfect. Thank you very much. Useful. Pick on this table now. Oh, you've got a remote. Good.
So looking at the food wholesaler one first, we started with a balance sheet, but then we went back to the P&L. But the P&L, when we take out the other operating income for the coronavirus, because it's not sustainable, those grants and stuff, we ended up with a really small EBITDA. So then we went back to the balance sheet to look at the net assets. But things like the debtors going up massively, and there's a bad debt provision one year but not the next year, the creditors increasing massively, then we ended up, in short, just thinking, well, there's an amount in the bank, there's an amount of stock that we, in a fire sale, we wouldn't get the same value. The investments is something we would be asking about, because what's this 400 grand of investment? So even if you could only get half of that back, so we kind of came up with a value of about 950,000. So we would offer 100,000 out up front, out the bank, and the rest deferred. So I think we're the stingy table, because the IT support gets even better. So when we're looking at that, with the wages going up, and yes, there are stuff going up, and it does make, on paper, money. But when we look through the balance sheet, there's no cash at bank, there's not really stuff there. So long and short, we've ended up with a sliding scale of value between £1 and 40,000. And that's as far as we got. And the 40,000 was as much on things like the stocks and things that we could sell off quickly. So we felt that this was too early to actually try and value to then buy, unless we specifically wanted some customers to slot into something we were already doing.
Of course. So I think the 2 points I'd make on that is there will be a lot of businesses that you're looking now that have been impacted by COVID in some way. And it's important to sort of understand that. It's also important not to have the wool pulled over your eyes that decline is down to COVID. You need to separate the two. So absolutely, that grant being there in black and white is really helpful, because it was impacted, they benefited from the grants. But some people, if they know that it is just specifically that year, what they actually do is correct the turnover and then do your EBITDA calculation, because you can't sort of discount the grant without considering the impact on turnover that COVID would have if that was a very temporary blip. So the questions I'd be asking there is, I need longer, I need much further back. I also need really the latest management accounts to see if the business has subsequently recovered and we now have a higher EBITDA. The other thing with the IT support is the benefit of that one is the recurring revenue. That's what tends to make that more attractive, or potentially get a higher multiple than another business, because if you've got contracts, enforceable contracts where these clients are tied in for a year, 3 years or whatever, then that is obviously recurring revenue. So you might look at it on that basis rather than a net profit. So yeah, but all good observations. Let me give it to this table. Anyone volunteer?
Okay. Well, I looked at the multiples on various websites to actually see what EBITDA multiples they use.
Good.
And I'm quite puzzled, because they're quite various different ones. For example, I found very accurate multiples of 14.01 for IT.
Wow.
And for food industry, I found 14.14, which is very similar. But on a different website, and it depends on how you categorize this. Okay, so this is IT support, but there may not be a category for IT support. There may just be something for software consulting, which is not the same. And that was a multiple of 89 or something. So it's insane. I don't really know how this is worked out. And is there no industry standard? Is it just at the interest of whoever chooses to come up with whatever value? So based on this, our valuations came up to, for the IT support, around 1.3 million, and for the food industry around 16 million. So
this is the generous table.
It's a generous one.
If I could just jump in
Please
as well.
do.
This is sort of a perennial subject where everyone wants to know where's this magic number, because we don't have to really worry about it, because if the number's on a website or a little black book somewhere, I can take that number and that is my number for valuing the business. Basically, the work's been done for me. Where what you will see is you get these variances, like in the exercise this morning, because it depends how much the seller is willing to sell for, how much the buyer is willing to buy. So those numbers that you're seeing there would be only, they would not be SME.
Right.
And SME is a big category. They would not be SME sales. They would be private equity deals where the multiple that's been realised on exit has been published. Because it's a fund and everyone can see what happens in the fund, or even stock market publicly traded multiples. So what you find in those is not relevant to what the majority of us would ever do here, in businesses in the single, even double-digit millions. So that's why you're seeing huge, crazy multiples, where at the end of the day, it's someone who wants to retire in 6 months' time, and you're the only person they've spoken to as a serious buyer in the last year, can we get a deal done? And that drives the value as much as, well, certainly not what it says on the website.
Yeah. Okay.
Do you see the difference?
Sure. Yeah.
Another question.
Really good reference points.
If you're finding, a higher multiple than what you would have expected, I think the next question would be, well, how long realistically is it going to take you to get that money back? So that's when you're looking at the cash generation and going, am I happy with that? Because if I'm not, then you wouldn't offer anywhere near like that. But there are other factors, a bit like we were speaking earlier. There might be potential for an existing business to sell all of their products to the customers of the business they're buying. Therefore, they're thinking, well, I'm going to make double this. I'm not just interested in the profits this company's making. I'm interested in what it's going to add to my existing company, kind of thing. Those are the things that would impact, really.
Okay, that's interesting.
Fabulous, thank you.
Thank you.
we table in the middle there? We pass back.
In the middle.
Yes, pass the microphone back.
You've got the wrong table. Is all I could say. I can speak for that table because I think we're sort of spread, so we're around the place. So I think reading and speaking to you. I think most of the comments have been made. We got on the computer company. We just found that it was so light. Obviously cash in the bank was zero. It was going in the right direction, so we felt that had some merit overall. And really looking at it, there's no credit card charges, which sort of confused us, but then it it confused me, I should say. So we understood why. We put that in the valuation of up to 100. And that there was the basis that it's going in the right direction. But as always, you're making assumptions without knowing exactly what the business is and where it's going. So that's where we got to on that. On the food company, that was the same. It was trying to work out. They looked like they'd had okay results, bearing in mind coronavirus, but then you're trying to strip out coronavirus. What does it mean? Where is it going? Again, you don't know, so you'd be making leaps of faith based on this as to where it was even before 2020, where it was in 2019, and then where is it going in 2022. So unless you've got those figures, you couldn't really come up with a valuation. But if you wanted to take a broad valuation, we went round the group and we got anywhere between 1 and 2 million on that basis. Have I missed anything? Anyone? Are we about there?
Yeah, I mean, so just going back to that, the IT company, that cash figure of zero, cash in the bank on the balance sheet, that really bothered me. So what should I have read into that?
So my assumption as an accountant would be that it's overdrawn. It's very unlikely to be nil. So the chances are that that figure, that the actual bank balance is a minus and it's sitting within creditors. That would be what I would assume. But again, it's an assumption. You would need to ask, why is there no cash in the bank?
Yeah.
And that would no doubt be the answer.
Yeah.
Hello. So we look to the food manufacturing business first. We're good to go, yeah?
Yeah,
hello.
fabulous. Hello there.
So the first thing we'd want to look at is investments, because there's clearly quite a chunky amount in the balance sheet. What does that relate to? Is it within the company? Is it separated? What have you? So a couple of big questions around that. The directors have obviously been quite heavy-handed with their dividends. So despite making 220 grand profit, they've pulled out 360 grand worth of dividends. So just some questions around that. The net assets has dropped from 20 to 2021. So the business is devalued. And also some questions around the liquidity, because the net current assets is reduced. So how much cash have they got? How can they pay their suppliers, etc. In terms of valuation, we would probably omit the investments out of it, because again, it could be separate. So we're looking sub 1 million.
Fine, really good.
For the IT company, again, we actually weren't aware it was an IT company, so we're just looking at the P&L and balance sheet. But we got to around 160 to 200 grand valuation.
Okay, and what made you go sort of higher than the general?
So we looked at just a multiple of profits, so 2 times profit, and then we added something in for the shareholders' funds.
Fine, yeah, absolutely. Good method. Who's next?
There's Rob. He done the argument because he was quite good at it.
It was hard. We didn't have. We thought that it might be COVID, but looking at food wholesale, it was not COVID, because normally they would do more. So that's strange, and we didn't have enough information. But how I look at, we had some difficulties. I look at it different, and thought they try to get the figures right in the end. So you have to look deeper. You have a lot of questions. Phil thought it was worth, it was 875, but I was less, without more information.
Sure.
Yeah.
And what do you think is the biggest piece of information you would ask? What would be the most important question you'd have for the seller?
Most important question, what happens? Why? Yeah, the turnover went down, and the customers don't pay anymore, because it goes from I think 6% or 8% to 19% or something like that.
Absolutely.
So and they didn't pay their creditors, so it's not a good situation. That's what you see.
The debtors is a really big one there, isn't it? But your question it is, what is behind it? That's the thing. The numbers are the starting point, isn't it? But what they answer will basically have a huge impact on the valuation, isn't it? And if they give you satisfactory
You can't make a valuation now on this. So.
Absolutely.
So what about the small one?
Got the group right in the back.
We didn't look carefully at the small one.
I'll go. So on the first one, it's the food one, isn't it? Yeah. So we probably thought it's worth about $1 million-ish. I know the balance sheet has about $1 million on it, but yeah, that's what we'd pay for it. We'd ask, are they up-to-date accounts? Why has the sales dropped? Any other things we'd add?
Yeah, well, the actual margin is low.
Margin's low.
Inflation,
Yeah.
that will be wiped out
Yeah.
this year.
Yeah, and for good point. And for both businesses, we'd obviously ask for up-to-date accounts, because these are not in date, basically. For the second one, the IT one, I'd want to know the nature of the contracts and the payment terms, because sometimes for IT services it gets delayed, and some might be upfront, some might be a year down the line. Don't know. The turnover increased. Why is that? But the margin dropped. Why is that? So that's it. And we'll probably pay about 100 grand for it.
Fantastic.
looks like I'm having a go. So looking at the food wholesaler, what we started to analyse the account, so it's not much different to what everyone else has done, to be honest. What we initially looked at was the debtors. We would ask questions like, can you give us the aging of the debtors? $1 million it actually, yeah, it's gone up a lot, but it all looks like they're recent debtors, so that could be good. The provision, the creditors amounts falling due within 1 year, we wondered whether that was creditors for purchases or whether it was providing for anything in terms of tax. Is there any provision in there for tax? So we just, it's quite a lot. It's $1 million. So what are they providing for? So we would want to ask that question. But when we looked at the overall picture, we just said, look, for the value of the assets and for the net profit it's returning, so the value of the assets, even if you take everything, is 1.1 million, and it's returning 300,000 roughly. Yeah, that's actually not a bad return, just on the highest level you could imagine. If I had $1 million worth of assets and it's providing me 300,000 worth of profit, probably isn't that bad. So we just said, look, what we did at the time, we didn't know what the company was, so we took a stab that potentially we would probably offer 2.5 times EBITDA. That EBITDA at 300,000 times 2.5 is sort of 750,000 is what it was probably worth to us. Where would we get the money from? Debtors book borrowing, we assume something like 70%, and some of the cash in the bank we'd need to retain some. So we thought that was a good deal. The last one we looked at and we said, you know what, it's almost illiquid. Let's leave that one and let some other mug pick that one up.
Absolutely. Have we missed anyone before I sum up? No, that was all the groups. Fabulous. Well, yeah, I think all really valid opinions. And what was great is that you'd already sort of started asking all of those questions and having those opinions before you knew the sector as well. So it was interesting to see the impact of knowing the sector on those opinions. For background, the IT support company, they are very small, only in their 3rd year, very aggressively growing. So pretty much all of the revenue they're generating is going back in to marketing, additional staff costs, things like that. The other thing to bear in mind with recurring revenue businesses is that the last 12 months very often won't show you where the business is at now, because what you actually need to do is project forward. So say they're taking on a lot of new customers every month. Those customers, if they're on monthly retainers, they're going to impact the next 12 months, but it's not going to show you a full picture. So that business could be twice the size of what you're looking at as at the end of that year, but you're not going to know unless you look at the forward projections kind of thing. So that's the background on that one. The food wholesaler, they did definitely have a difficult time during COVID, obviously completely shut down. Many restaurants sort of stopped ordering. But we have been working closely with them on a consultancy basis, and we've actually managed to get them up to about 100 grand a month in profit that they're generating at this stage. And that was predominantly by scrapping the refrigerated food side of what they're doing. So the cost factor for refrigerated food is significantly more than your jars and your cans and all of that sort of thing, which impacts the margins. And with the energy situation that's going on at the moment, they were set to go up, their energy costs were set to go up about £8,000 a month for their refrigerated warehouse. So they've got one for refrigerated goods and one without, and obviously the vans as well. And there's also a lot of wastage with the refrigerated and the frozen side of things. So removing that element from the business didn't have a huge impact on turnover, but had a huge impact on the profitability kind of thing, because they just put their energies into a different type of product. So that's the sort of thing you can do, looking at these businesses in detail and breaking down those numbers and looking at KPIs. And we never recommend, looking at turnover just as turnover. You want to know what the individual products and services are and how profitable they are, because there might be a part of a business that is actually really attractive, but it's carrying another loss-making side of things. So ask questions. That's what I would say, definitely. That would be my thinking. Thank you very much for today. Question?
Right. We've all gave a value of these businesses. What would you value them at?
I thought you might ask me that. I would have paid a lot for the food business, definitely. I would have probably gone to 2 million for that one. Yeah, so I would have gone higher for that. The IT support, purely because it would be outside of my knowledge as to how to grow that further. And it's the risk factor as well. I was involved in an IT company at one stage, but I pulled out, and the reason being the growth got to the point where, you know, as a director, I'm having to sign off insurance documents and stuff, people's data, cyber attacks, saying, yes, we're doing this, doing that, thinking, I don't know, if my printer's not working, I'll turn it off and on again, and if it still doesn't work, I'm lost. So it was, for me, you know, more of a liability than maybe it would have been. So, yeah, my answer would be different in terms of what I would value it as and what I would for someone else who's in IT or as a bolt-on, if you know what I mean. But I think it would be, again, with the knowledge I have of the company and its growth, more than what that piece of paper would say.
That's good.
Was that a diplomatic enough answer?
Yeah.
I think it's great. What a good afternoon. Joe, thank you very much. That's very good. Thank you. And if people want to contact you, do you have a business card?
Yeah,
you have a business card.
Come and see me at the end.
Fantastic. So, good day? Yeah. Brilliant. So I will see lots of you. When do I see you next? It's on the...
Thursday, yeah.
When are we meeting in December? Oh, the 9th. The 9th. Yeah. And the night before, that's it. So Thursday the 8th in the evening. So we've got Inner Circle in the daytime. We've got the Christmas dinner and awards. Awards are going to be a good one, you know. We've got New Deal Maker of the Year. We've got Deal Maker of the Year, Advisor of the Year. It's going to be a really, really good evening. And then the next morning, we're back in this room. That's going to be an interesting, an interesting start. An interesting start to the day. And I'll see you on a Zoom in a few weeks' time. I'm not sure what the date is, but you've got the date in your diary. And some of you I'm going to be seeing down in the bar in about 5 minutes' time. If you'd like to join us for a drink, please do so. If you haven't been down and joined us for a drink after one of these events, you know, just stay for 15 minutes, and it's nice to socialise with the people that you're working with. And Joe, thank you very much.
Thank you.
Great input this afternoon. And everyone, I'll see you next time. Thank you.